So, dear colleagues from all member institutes of SUERF, the European Money and Finance Forum, ladies and gentlemen, also from my side, I would say a very warm welcome. Good morning here to our head office here at Bank Austria campus for today's event on IE and in banking and finance. As I think we gather today, we recognize, and I think you're all aware of the key role of innovation that innovation plays today in shaping many industries. I'm deeply convinced, but also especially the future of banking and finance sector, and in an ever evolving landscape, embracing cut-edge technologies. It's from my perspective for many industries, but again, especially also for us in the banking and finance industry, it's not only a choice, it's a necessity. And artificial intelligence stands, from my perspective, in the forefront of this transformation. But also certainly AI is much more than just the buzzword of today. I had the opportunity some weeks ago to have intensive discussion with some very relevant people in this industry. So when we talk about AI, it was the CEO of Google AI, or Mustafa Saliman, or also the CEO of Google DeepMind, or the CEO of Palantir, Alex Karp, were also very interesting. What is the future? What are the risks? What are the topics they consider today? And we are all talking about a wide range of possible application that is only being utilized in a small extent today in many industry, but also in banking. And of course, from my perspective, as with any I would say powerful IT application, and maybe some of you know that in the past I had a little bit background out of this. As let me say, in Bank Austria, my starting point in the board was as a COO. So again, as any powerful IT application that collects and stores and process personal, but also sometimes sensitive customer data, company data. AI is also required or requires a sensible regulatory framework that ensures data protection as well as data security and prevents also data misuse. And also here the discussion, of course, and I'm curious also then to see the panel discussions that many people say US is innovating and Europe is regulating. In some perspective, I think this is not completely wrong, but on the other hand, I think it's also important now how we implement this. We have seen, for example, also research how entrepreneurs deal with the European regulation, which should be very common in the European framework. And so while in the Nordics, entrepreneurs see, let me say, the regulatory framework for their, not only banking, but overall, to limit them much less than, for example, in Austria. So 30% in the Nordics says, okay, regulatory framework is here, but it doesn't limit our development, while here in Austria, for example, more than 70% sees this as a limit. So I think we have to deal with the regulatory framework. I think it's also an advantage in a certain way, but on the other hand, also we have, in terms of mindset, a little bit also change this, how to deal with it. But I think our bank, like every other innovation-oriented bank, I think will certainly continue to closely examine the opportunities, and there are a lot that artificial intelligence or KI brings and utilize within the European and national regulatory framework, and also with the applicable guidelines. But however, that much is certain today, that despite all the question marks of the development, and I think here we all of you, I'm quite sure, let me say, monitoring is how advancing is very swiftly. I think I would say all agree that AI is a powerful force that will not go away, and is the way how we deal with it, how we utilize it, is, from my perspective, has an enormous potential to drive efficiency. Just recently I've seen also a study from an international consultant company in which area they see a kind of disruption also in the banking and financial industry. I partially agree, I have to say, because I don't see they focus very much on the risk. I focus very much on the opportunities. Of course, we have to deal with the risk, but I think there is really enormous potential to drive efficiency, risk management, to improve the customer experience. I think from my perspective in the banking industry, there's a lot to do compared to other industry, and now those days customer of course compare the experience they have in other industry with also their experience with us in the banking and financing sector. And I think we're also with our industry's commitment to research and development, I think in this way we are making also a concrete contribution to ensure that our banking and financial institution remain agile and also competitive to many other players. But we also know, but this is not only for AI, this is for any innovation that doesn't happen in isolation. It thrives when it is, I think, supported by collaborative efforts, by groundbreaking research, and as we look ahead, fostering innovative research becomes paramount from my perspective also for the future of our economy here in Austria, but also in Europe. And I'm sure that also Unicredit Foundation is making an important contribution to promoting these goals. I think maybe not all of you, but you're aware that the foundation's priority areas are school, job, university, and on strategic focus also on supporting studies and research on fields in the economic and finance area. And in this way, as also the main reason for today, and therefore also I'm delighted to have the opportunity to congratulate also the winners of this year research prize, who will be presenting also their winning papers today shortly. And on the one hand, Maximilian Goebel from Bocconi University for his paper Maximally, machine learning portfolios, and his co-author Philippe Colomb from Quebec University, and on the other hand Thibault Cézanne from ZTW Mannheim for his paper managing bank manager sentiment, I think, excessive loan growth and underestimated risk, and also his co-author Frank Bruckbauer from ZEW Mannheim. I'm very much looking forward for the upcoming presentations and also the following panel discussion on how AI is transforming banking and finance and which opportunities also we see there. And thanks everyone for being part of this, at least for me, exciting topic, exciting journey. And once again, congratulations to both of you and your co-authors. And with this, I would like to hand over to Ernest Gnan, the Secretary General of SUERF. Thanks a lot being here, and looking forward to the interesting panel discussions. Thanks.
Thank you very much, Mr. Zadrazil, for your opening remarks, for hosting this event at your Unicredit Bank Austria premises at this beautiful new campus, and for the long-standing cooperation of Unicredit Bank Austria and Unicredit Foundation with SUERF, the European Money and Finance Forum. I have now the pleasure and privilege to welcome today's keynote speaker, Christoph Bornschein, who is chairman and co-founder of TLGG, which is a digital business agency and consultancy operating in Berlin and New York. Christoph co-founded Germany's first social media consultancy, TLGG, and advises global businesses and policymakers of the strategic use of digital technologies. Christoph is a well-known keynote speaker, podcast host, and guest, and writes for numerous publications including FAZ, Die Zeit, Süddeutsche Zeitung, and The Next Web. He maintains regular columns in the German publication Manager Magazine and Handelsblatt. His expertise covers topics such as energy transition, fintech, future work, European competitiveness, and digital single market integration. Christoph holds several board transitions, and we had a conversation before the event started, and I understand that Christoph has his fingers in many companies around the world. and has a huge network of firms and experts. In 2021, the World Economic Forum named Christoph a young global leader. After 15 years as TLGG CEO, Christoph has become chairman in June 2023 and was appointed Omnicom's president of digital strategy, business development and growth in Germany. Christoph, a warm welcome. Thanks for coming to us. The floor is yours.
Thank you. And thanks for the very long introduction. It's a pleasure being here. And yes, I do something that is now called a portfolio career. So I run multiple businesses, and I'm invested in multiple businesses. And to calm every banker in the room, I actually have been a half-time banker myself as well, in the time that I was on the supervisory board of Deutsche Bank's retail business. German BaFin and the ECB think that I'm fit and proper, which just it serves as confirmation for all of you that are as well. And I hope, I'll take the other clicker, that's fine. Without further ado, let's just start talking about the unknown unknowns and some thoughts and reflections on AI's impact on banking and the kind of broader society and economy. And to start that off, I actually have something that is rather unlikely as AI prophet. This is Donald Rumsfeld, and for 1 second, let's just forget where he said that and why he said that, and focus on what he said. And that's actually quite interesting because it kind of gives a great framework of looking on the development that we're seeing right now. He said, there are known knowns. There are things we know. We also know that are known unknowns. That is to say, we know there are some things we don't know, but there's also unknown unknowns. The ones we don't know, we don't know. And with that as a guiding principle, it's pretty much what you need to know about AI. All of what Donald Rumsfeld said back then is very much true for how to look at AI right now and how to understand and cope with AI. So what we always saw is that we were able to predict the direct impact of technology to a certain extent. That's the so-called first order effects. The internet enabled social media in the end, which then led to what we've seen across Facebook, Twitter, and all the others. That's a very logical linear effect. Smartphones have enabled mobile banking at some point. So the Revoluts, the Apple Pays, the N26s, the Trade Republics, and so on. That's kind of a logical consequence. And now comes the second order effects, and let's focus for a second on Silicon Valley Bank's default. The combination of social media and a digital bank account sitting on your mobile phone is that a shitstorm on Twitter can directly lead to a bank run, which then can lead to the default of a bank, which is a traditional second order effect combining two things that have happened to something that has never happened before, and it was not really predictable. At least they did not be able to predict that. Same holds true for what we're seeing with the so-called meme stocks. So the availability of access to the stock market at zero cost with Robinhood, combined with platforms like Reddit that accelerate communication and memes to quite a bit, led to GameStop being totally out of control when it comes down to their market cap and the way their shares develop. That's pretty much the kind of logic on first order, second order effects. And now the problem is, looking at AI, we're trying to judge something that is barely 2 years old, at least when it comes down to available models, so LLMs and B2C options. And we'll not only see second order effects in the short term, we'll see third and fourth order effects, because the wave of internet e-commerce is not out-developed right now. Mobile and cloud play a massive role in development. We had to learn that Elon Musk just bought 3 billion worth of NVIDIA GPUs in order to power his autopilot. So he's now the, I think, fourth biggest owner of computing power. That is going to change stuff. And then on top of that, GenAI and even Web3, so the blockchain hype that is not a hype anymore, sits underneath that as well, will lead to a lot of developments combining into unforeseen effects, which then is connecting us back to Donald Rumsfeld, because the number of unknown unknowns has never been bigger than right now. There's just a lot of stuff that will happen that we can't foresee that is happening. Which is why the Rumsfeld framework that I want to introduce today looks a bit like that. There's the known knowns, so the things we have understood that AI is going to change, that we should definitely focus on, and where we lose competitiveness if we don't. Then there is the known unknowns, so we know that some things will accelerate, we know that content and content generation is going to be around to stay. We know that this is going to have a consequence on trust and relationships. We know that authenticity in the internet is not longer granted, which leads to digital identities being an important thing. So there's a lot of stuff where we don't know how exactly it's going to play out, but that it is going to play out. And then there is the speculation, which, and I'll show you some examples, could lead to constellations like the fully autonomous bank. So a bank without bankers, a bank purely made out of software, that is fully autonomized and personalized in everyone's pocket. So this is something that is not totally unrealistic, but we don't know when or how it's going to happen. Let's start with the known knowns, and the known knowns is a pretty easy one, owning a piece of the AI cake, because it's just a matter of competitiveness. Who is not automizing, and excuse my French, the shit out of everything that can be automized is going to lose competitiveness, is going to lose EBIT in the long run, and is in the end not going to be a competitive player in the respective market. So in banks with a crazy process model, automizing all and everything, and the wave of robotic process automation has happened quite obviously, has yet have an impact as far as I would have expected that to be, but this is pretty true. Problem is that capital eats strategy for breakfast. In this case, it's really down to the availability of capital, access to cash, and willingness to invest. The problem is that AI in the end is pretty much of a hardware game. Starting from the silicon, it is and does play a role how many GPUs you can buy from NVIDIA. It is a question of wages and salaries you can pay. The researcher that does do the WU here has to decide over staying in Austria for a fifth of the salary that is paid in Silicon Valley. That is going to play a role in that. And the situation is not good. So the assumption that you can see on the chart here is we need to be 11 times smarter than the US in order to outcompete their 11 times higher investment into everything that is AI. So Europe is massively underinvested in everything that is future-looking technology, which is going to lead to second and third order effects as well, because it is a cornerstone technology that is going to open doors to other technologies. If we don't invest in that, maybe we'll be falling back behind in quantum computing, in quantum internet, and everything that comes behind that. There is signs that of interesting development, and all of you follow that. Mistral just a week ago have announced their $6.2 billion valuation. The problem is, and that sits down on the chart, most of the investors and most of the capital is not European capital. It is a European startup fueled by American money, which from a sovereignty perspective and from is that a European company or an American company that by accident is based in Paris puts some questions out there. So my read would really be, it is not adding to Europe's sovereignty other than Macron tells us. We are having, and we had that problem with other companies like Celonis, with UiPath, and other European companies that then turned US companies or US money-fueled companies that it's not going to help our sovereignty. We do have the talent to compete. The sign, so Meta, for example, from Facebook, has their AI center in Paris. Mistral is in Paris. And we've got crazy loads of patents being filed in there. The problem is that the value carve-out a lot of the times happens with US money in US P&Ls because the core investment money from Mistral, for example, comes from Andreessen Horowitz and not a European investor. But we need structural change, and that now is something that is banking related. The capital market union and the digital single market in Europe have to be done and completed as soon as possible. I don't know whether Christine Lagarde is right or wrong, but she assumes that for 4,500 companies across Europe with 500 billion extra raise in cash would be the consequence of a capital market unit, the consequence of a digital single market, so allowing a European startup without regulatory borders to accelerate across all of Europe would massively contribute to that. And whoever has started a pan-European banking business or a pan-European insurance business, which I both did, is going to learn that we are far, far away from being a single market. It is still very much national regulation, even though we assume that GDPR and AI exchange stuff, the special matter regulation still is very hindering in European-wide scaling. And that needs to be changed. Europe needs to be used as a single market of 400 million people, because otherwise we'll just not build something that is competitive against something that has been built in the US market. Over to the known unknowns. I think we're in a time where we have to lose weight while building muscles at the same time. And yes, this is your personal trainer speaking to you right now. It is not new in banking that we're seeing a massive acceleration in automation. Jamie Dimon said that there's over 400 use cases in his bank already, but acceleration needs to happen. So everything that is optimized contract work, optimized processes and stuff like that needs to be unlocked. And the issue really is finding a narrative on that, because I feel that in core European countries, we still got a discussion going on the tech-induced unemployment, so people being in fear of losing their jobs. I think that is totally wrong. The true story is none of the core European countries has a demographic situation where it can afford to have people do the same old shit and the same old stuff. To just give you a caretaking example, an elderly caretaking person in Germany does 45% of their time in front of a patient and 55% in documentation. Is that the right use of human time? No, it isn't. And we need to reframe that discussion in exactly that. Why should we have people working on repetitive tasks that a computer can do better? For me, and I think that is the narrative all of us as leaders in our respective situations need to adopt. It's really down to treating humans like humans means automating stuff that can be automated, because if you're a task monkey, that is not putting you into value, and that is not paying a lot of respect for human labor. And I think changing that and really having that concept being adopted is important. So it's two things that need to happen, and I know it's a bit drilled down. It is around driving efficiency and driving innovation. And the revenue grows while cost is decreasing is clearly what you need to focus on. So Klarna is always a great example where the assistant is already doing two-thirds of the customer services, freeing up the resources to then actually invest in innovation. And that is a bit of the problem. Looking into the banking world of today, it is too much on fixing your core business, automizing your processes, and not enough on future growth. So I feel that a lot of banks that I have had the privilege to work with are really good in managing their cost lines and focusing on what to automate and where to kind of apply automation on the cost base, but they really suck in growth, innovation, and true value contribution through technology. I've seen little banks, and I'm not judging any, that really have applied AI and technology to actually grow their businesses, come up with business model innovations and stuff like that. And I think that is where the focus needs to shift to now that AI adoption is happening, and now that more and more of the AI tools are not longer complex or hard to get. As I said, that is where it leads to. We see a lot of better business, so improvement and more of the same just on AI. We don't see a lot of new business, even though there is ideas around, and I had the privilege of publishing some white papers. Banks can be an interesting player in data markets. Banks can be interesting custodians when it comes down to data exchange on carbon data, for example. Banks have a regulated trust layer that can be a competitive factor where it is now only seen as a problem. So innovation around what is the upside and the advantage of regulation and being regulated, for me, is something that I would definitely start tapping into, not just only focusing on fixing the core. And last comment on that, just to say something mean about Goldman Sachs, outsourcing innovation to Apple in the last months proved to be a very wrong idea. So the whole consequence of we're gonna look into a tech partner, and Deutsche Bank at the time I was there and decided to put everything on Google. I haven't seen much of innovation happening, and outsourcing innovation always is a bad idea because the third party is going to be innovative, not you as the first party. So it's really around the question, how do you build innovative platforms and how do you maintain them inside the core bank and not outside of that? And now over to the most interesting part of Donald Rumsfeld, even back then, the unknown unknowns. So what is the speculation on future experiences? Just for very quick examples, the first one is, from my perspective, the democratization of the ultra-high net worth individual experience. So, or any other, it is a AI that will be financially advising. It's basically taking the highest human density in consulting and advisory to a level where the AI can do all and everything. And I think that's like 5 years out. This, I don't want to show the movie, but this is the scene out of the WeShare movie where the WeShare founder comes in to talk about his new bank, and they have got this special tequila at hand because they know everything. And that's pretty much where this is going. Data is available. I can know everything about everyone. Now put to work in advisory products. That's where this is going. And this is going to be the pave of the way for autonomous banking. So strategy adoption, asset allocation on the private side, but in the same moment for the CFO with a CFO dashboard. So ERP integrated banking as a software, even in B2B banking, it's not that far away. Because what we're seeing is when companies adopting to the sales forces of this world, all processes digitizing within companies, why shouldn't you automate the treasury? Why shouldn't you automate liquidity planning? And why shouldn't you just introduce and integrate the bank directly into the CFO's office? There is no reason for not being embedded with all and everything and not being automated with all and everything. It's not that far away. We'll see the cat and mouse deepfake KYC game. Deepfaking a video that then will allow me to open up a bank account, possible. So banks will take countermeasures to understand deepfakes even better. Then the deepfake side is going to take more measures and is going to create more valid profiles. So we'll see fully artificial humans with a track record, with a Reddit profile, Twitter profile, and all the likes. It will be hard to tell that someone is artificial and has been created by a machine, because I can fully automize the communication of a person that I made up based on ChatGPT already. So coming up with an artificial human that posts on Facebook, has friends on Reddit, and writes some interesting tasks on a Substack newspaper letter, possible. And I can do that just with a click. And this is really going to be something that we'll be seeing massively accelerating in banking and in media, quite obviously. Deepfake KYC, it's going to happen. And then it might lead to the manifestation of the populist meme finance. Influencing stock market with bots and trolls, with Reddit posts, and pushing up any stock on the market hasn't been as easy as now, and that can lead to a massive change of public markets and how public markets work. And whoever has bought a GameStop share at some point in history has seen what happens with that. Financial decision making is going to be nudged by different stuff. This all can be automized, it all can be faked, and this will be interesting to see how public markets develop on that. AI is definitely going to be the catalyst for the good, the bad, and the ugly. That's for sure. We'll see a lot of the ugly in the upcoming race for presidency in the US, because as much as the Obama election has been the igniting point for social media and the use of social media in political communication, the upcoming election is definitely going to change the game in terms of AI, in terms of AI-generated content and videos and stuff like that. So we're just about 6 months short of massive impact on learning what is possible, the art of the possible. So Donald Rumsfeld's strategy in this case would be threefold. We have to understand that AI will be massive. We know that AI is going to change banking. We just don't know how. And we know that AI is going to delight and confuse, and that it again is a threat to the existence of banks as we know them. So the consequence in terms of building a strategy is allocate buckets and build a portfolio of projects optimizing against 3 of those waves. Let's make sure to own a stake in that. That's what banking are good at, fixing the core. Then the next step, and banks are not good in that, let's make sure to proactively figure out how. That means bringing technology into the core. That means cracking the silo between the business and the IT, end-to-end product organizations, and innovation inside of banks. And the unknown unknowns, it's let's make sure to be prepared. Banks need to be technology organizations, and they aren't. They genuinely aren't, even though they believe that they have made a shift. The true reality is, I don't know any bank that has gone as far as they would need to go in order to compete with the trade republics of this world. And what we're seeing as a consequence from that, and that's a very German statement, but Trade Republic now has so much asset under management that it has become a clear challenger of asset managers of traditional banks. And the acceleration took place in just 2 years, and that can happen in any banking business category by the further development. With that, I thank you. Thank you.
Thank you, Christoph, for this very stimulating presentation. Christoph is open for questions.
That's true.
Franz.
I think we need a microphone for everyone in the stream.
Thank you, Franz Nauschnick, formerly Austrian Central Bank. I have a question. You didn't mention digital currencies. You didn't mention stablecoins. What do you think about this?
They are relevant, just not as relevant as the other stuff. So it is an influencer of third and second and third order effects. It's just like, it's basically the assumption of a fully digitized currency. It's just calculated in already. So I think all of this is exciting for bankers. It's just not exciting for anyone that has to do with currency.
Please. Mr. Zadrazil.
I'm not sure if it's it's still working. No, I think thanks for these insights. I think what for me is always important, you mentioned it, of course, I agree that theoretically a pure digital bank is possible, or there's no reason. Which I doubt, I have to say, because yes, it's possible, but the question in which segments, and let me say, we as Unicredit Bank Austria, we are a universal bank from, let me say, retail, affluent, private banking, up to large corporate business. So therefore, my view, my main question would be, which from your perspective, in terms of efficiencies, in terms of disruption, what in terms of what we will see as quick as you can imagine, and where are the areas in a universal bank as we are, where it might be possible. I think, of course, you can talk about an avatar for advising, but at the end, someone has to learn those. And I think here I also, especially when it comes to the complex business, and we have seen in the digital banks, you have seen that the business model has also their limits when it comes to advisory and to the normal stuff so far. So what is your view, how it will emerge?
Two perspectives perspectives on that. So I think that there's always two things that happen. The first thing is losing the interface, and the second thing is losing the business. In B2C, you pretty much are beyond the cliff of losing the interface already. So if you look into, let's just take your friends at HVB in Germany, and mortgage business, so B2C business, the price comparison rate and the market share of price comparison and customer advising platforms is 60% plus. So you are basically just fulfilling something where someone else owns the interface. B2C is gone. And I'm pretty sure this is going to give you some hardship, since now we're seeing that the neobanks are really picking up in business when it comes down to investment, when it comes down to pension planning and stuff like that. So that in itself is going to be a tough one, gaining back the interface. I think the big and massive chance that you now have is understanding what has happened in B2C and applying that to B2B. So if you look into B2B and CFO cockpits, for example, so finance planning management, and a French company called Agicap that is automizing all of that. It's basically the same thing that happened in B2C now starting to happen with B2B. And I think understanding that and riding that wave to fully integrate into CFO processes, double down on the embedded finance wherever it's possible, and HVB is doing something in that already. That's really important because the second wave is going to be B2B, and this is to a vast degree where you earn your money. So I would try to be the best digital partner for the CFO that integrates deepest into the CFO cockpit, into the CFO organization, and offers digital services. This is where you still got the chance to A, defend the interface, and B, grow with your customers. And then quite obviously wealth management and affluent and stuff like that. There's chances out there by doubling down on UBD AI, so democratization of wealth management, for example. That is something that you most likely will be doing and not someone else. You means the broader.
Please.
Thank you very much for a very insightful presentation. You mentioned in your last remarks that banks need to become more technological companies, but the banking industry is heavily regulated, and we know that there are certain restrictions to that front. Yeah. So what would you recommend or share your views in the sense of what banks can do to become more agile and become more tech-driven in that front?
There's two answers, and answer A is reframing regulation for me is important. So building products on top of regulation instead of mumbling about regulation for me would really be the kind of next step. So we are proudly regulated, which is why you can trust us in handing over critical data. For me would be a product promise that I would double down on, leverage. So and I see no one really going in there. So why isn't banks trust as a partner? Why isn't banks data exchanges in supply chain, for example? Why is no one really building products on top of taxonomy and carbon tracking and carbon accounting? The regulated core of a bank IT is way more trustworthy in that than anyone in the market. So that would be the part for the kind of core system. And then the second answer is more a kind of shareholding equity answer, and that's a build unregulated facilities by not directly owning the IT parts. So it's really how do you manage partnerships, how do minority investments look like, and how do you behave in minorities, and that is portfolio management to a certain degree. And I think I've seen little banks that really were successful over a long time managing partnerships where they took an equity component but not the full majority, and I think you need to improve in that in order to create zones of reduced regulation and reduced complexity.
This question was by Miriam Fernandez from S&P, and now Rainer Glaser from Oliver Wyman. We can hear you.
Yeah, very good. I have two questions, if that's okay. So the first question would be maybe connected to what you just explained is, from your perspective, what is the role that the banking industry could or should be playing in the AI story in the future? And the second question is, are there unknown knowns in that space?
Unknown knowns. Okay. Donald Rumsfeld is
just completing that matrix, right?
Donald Rumsfeld, yeah, he didn't do a 2x2 matrix because he was a minister or secretary of state and not a consultant. So he was only doing 3. So AI, and I would move a bit away from, or let me split the answer in 2 parts. So for me, there's 2 parts to that, which is A, the data side of that, and B, the algorithmic side of that. And I think we tend to mixing both of them up. So on the data side, I think the role of a bank can be massive as a trust broker for sensitive data across supply chains. What we're seeing is with CO2 accounting, biodiversity accounting, and all ESG accounting, the cross-supply chain access to sensitive data becomes something that is a factor of competitiveness for banks' customers. And I think there's a lot of opportunities where you can be the data exchange platform for biodiversity data, for example, for carbon data, because we'll see that direct measurement and integration as a ERP value, that's going to be the new normal. But the problem is you don't want to expose your CO2 emissions to the next step in your supply chain. So someone needs to build trust on that. And that's just as an example. So I think what banks did to money, so securely keeping it, they now need to do to corporate data and supply chain data. And I think that then is going to derive to, if the data sits with banks, you're going to build on top of that the algorithms that will help that. And that's an interesting role to play. On the algorithmic side, so on the direct AI LLM side, I don't see much of a role with banks because we'll see, and we're just so close that LLMs are just good enough. It's like no one has invented their own browser in order to be part of the internet. And that's how I look at LLMs right now. It's basically there's good enough LLMs out there. It's the process integration, workflow integration, and it is the use cases and tooling that you have to build and focus on, so the middleware. And banks can play a role, and going back to what I just said, for example, in CFO offices. CFOs will need to kind of build LLMs into workflows. There is no one that does that right now. There comes banks, potentially.
Thank you. Are there any further questions? Yes, please. Please wait for the microphone and say your name.
Anna Pauls. Yeah, thank you. Well, what AI model does, it always depends on the data that it has access to. Now, you mentioned the potential of AI financial advisors, and you also mentioned the potential of AI fraud or, social engineering and all that. Well, that can be powerfully combined.
Yes.
Yeah. And at the same time, well, the data that the AI has access to is kind of an echo of what has been happening up until now, whereas we're facing a lot of structural breaks, such as, tipping points of habitats and so on. So these affects the risks that actually should be taken into account. And also, as you say, nobody needs to invent a browser themselves to access the internet. So these are systems that then can become a black box and involve dispersion of responsibility and incentives, how to mitigate that risk by way of human supervision.
Yeah, that's an amazing question and a session of its own. But let's just stay with the societal challenges for a bit. So there, from my perspective, there's 2 problems. Problem A is lack of literacy, specifically in Europe, in kind of the broad scale. If you look into DESI as the indicator, the problem is that we're just not well enough educated for the tech world, and we're kind of the region that is only user, not producer. referencing the TikTok discussion and how wrong we are about the nature of TikTok, whatever. So education and from first class on in technology and how technology works is key to that. And then it is, and that is why I was tipping in sovereignty so intensively. The problem is that code is exporting values. So Facebook's freedom of speech values have always been different than ours, which is why swastikas were okay on Facebook, but nibbles weren't. And the same holds true for TikTok. So it's always said that TikTok is not granting visibility to democratic parties. Yeah, because the producer of TikTok isn't a democratic country. So code is exporting the values that sit within the code, and we don't build European code that is representing our values. So the question of competitiveness of the European cloud and AI and whatever industry is a question of building stuff that reflects our values in opposition to just working on stuff that does not and trying to regulate that they maybe just act by the law. And as long as we don't gain competitiveness and eyeball level, this is not going to change. Educating, being competitiveness.
Thank you. Are there further questions? Otherwise, I would come in with one of my own. Is it easier, in your view, to build an AI-based bank from scratch, or to build on an existing bank and transform it?
It's greenfield. So the answer always is it's easier to build that greenfield. So and look into Robinhood, Trade Republic, Revolut, and stuff like that. It's all greenfield technology because changing legacy is always harder to do. And we've been talking about the kind of digital readiness of countries. Estonia always plays a role, yeah, because they built greenfield.
But then, you know, there are also nowadays rankings of banks, how far they have proceeded in terms of AI transformation. And as far as I remember, JP Morgan is one of the leading ones. You quoted Jamie Dimon. So how does he manage? I mean, they were not an AI leader in the first place. So what's their recipe?
I would question whether there are today. I would not trust any kind of ranking where I don't know the input. So in principle, AI adoption in the banking industry just means straightforward use of what is around, and automizing the shit out of a bank is basically, yeah, that is now called AI transformation. It's not really overwhelmingly great. So, and that's kind of what I see and what I tried to say. Banks are, and JP Morgan is a specific example for that, fixing the core, doing better business, doing more of the same, doing the exact same stuff, just automated. That's what banks do, and that's what JP Morgan is good at. If you look into business models that JP Morgan has built based on data, and they're now starting to do some whatever retail media stuff and so on, they're just as good as everyone else.
Okay. We talked about literacy, digital literature. Yeah. And this also goes back to the question posed by Mr. Zadrazil. So what do you do with the digital illiterate, with the elderly, who don't have a computer, who don't know how to handle a computer, who don't even have a cell phone, you know?
Yeah, that's going to be a tough one looking forward. So at least don't let your agenda defined by them. So I think where it starts to get problematic is where you put in a lot of effort and investment to keep up with old processes. I had a conversation with Germany's Minister of Traffic, and he basically said to me, Germans quite obviously like paper tickets for public transportation so much that they don't adopt to a digital ticket, which is total rubbish. It's that this is always the kind of backdoor that you use in order not to digitize. So the question really is, how do you build digital first? And then on top of that, build the kind of legacy processes. So look into, I don't know, those customer advising platforms like Interhyp and stuff like that. What they basically do is they've got shops for mortgage comparison, and that is a place where someone sits with you and walks you through the website. But nonetheless, the digital process is the core process. There's no other process other than a human being explaining another human being what is on the website. And that's good enough. And I think we need to kind of, and Europe, or core Europe, and German-speaking Europe, is always a lot about the weakest tie is going to define the process. And this is how we don't get anything done.
Okay. You mentioned the aspect of financing in your talk.
Yeah.
Capital market union, incompleteness of capital market union. So, two questions there. First, have you experienced yourself with your companies that the lack of capital market union causes frictions, prevents business from happening, causes unnecessary cost? And the second question is, what does Europe need beyond capital market union to get this AI backlog, being caught up?
Answer to your first question is yes. So what you see kind of in a serial manner is allocation of European capital in large-scale investment rounds is always harder than allocation of Chinese or US-based money. So I've seen a lot of companies that I'm personally invested in where it was way easier to get the money out of Tencent in China than any European investor, even though we're talking about German companies. Same holds true for Mistral. So Andreessen Horowitz is just a more advanced investor with bigger allocations at one time than anyone else. We've got money sitting everywhere. It's just not allocated in capital allocation accumulations, and that needs to change. We need to have big-scale European investment facilities that have pension fund money at hand and that can do $1 billion in investment just because they do, and we don't have that. And that shows results. And what was the second question?
Second question is, what would Europe need beyond a better capital market union?
And that is the reflection of that is digital single market. So we tend to believe that now that we have the AI Act and GDPR, it's all one market. The true reality is, if you look into whatever, the energy industry, for example, if you want to start a smart metering connected solar play, you'll learn that we're still 27 markets, not one. And that needs to change. You need to be able to conquer European markets as European markets and create synergies in being such a big market in a digital world, which is not the case.
Final opportunity, 5 minutes. We have 5 more minutes to go. Final opportunity for a question. Yes, please.
Thank you. Thanks very much. It was very interesting. And I have one question, because I'm coming from the central bank, so I'm coming from the supervision perspective. Do you think that all these changes that will or might happen in the future will have a very big impact on supervisors? And if you think so, in what respect?
Clear yes. And I can't expose that, but I had discussions on automizing regulation and enforcement of that, and that can be done. And then we're a bit back in the blockchain / clean data room discussions. So the way data transmission happens between the regulated banks and the regulator, it's ridiculously old school. So why not do that in encrypted, automized ways? If you look into the FTE growth of banks, the only area where banks grow in terms of FTE is the compliance part and the regulation part. Everywhere else, they basically shrink. And that tells me that we're applying regulatory processes that are very manual and that don't need to be manual. So my take is really, you as the regulator are a potential driver of competitiveness, because you are the only fraction that can take even more money out of the cost line than automation efforts. And I think if you understand that to be a global competition of some banks, and that's true for the Unicredits, that's true for the BNP Paribas, the ING, European regulation has to be automated in order to make them more competitive in their global businesses. And I see discussions happening in there, yet not a lot of action.
You want to follow
Thank
up?
you.
Mm-hmm.
I think there are a lot of projects that are trying to to help in this respect, but I guess you're right. There's a lot of work to be done. Thanks.
Is there another question? Yes, please.
Oh, okay. Yeah, hello. So my name is Thibault. So thanks a lot for the super interesting presentation. I was wondering regarding the fact that traditional banks are not involved yet enough, at least in Europe, for like this AI and machine learning. I mean, isn't it actually already happening that, for instance, I think about from French point of view, so I don't know if it's the same for other European countries, but like Société Générale has its own online banking, like Boursorama, BNP has its own as well. So that's my first question, isn't it something happening actually already? And the second is also related to this regulation. So I agree with you. AI is an amazing opportunity to try to automatize this, regulating and supervising banks, for instance. But isn't it also a challenge, actually? I mean, you saw that now it was kind of easy to fool a bank to get a credit. So if you just, small households that do it, it's a lot of exposure, it's fine. But imagine like big corporates that would say, just as ChatGPT just generates, the best kind of, like communication for my firm to obtain the highest amount of money for the cheapest interest rate. And, how do you, do you see that?
So to your first question, and I didn't say that nothing is happening. So and France, by the way, is and as a German, we just have to accept that French is the lighthouse of AI development in Europe right now. It's just factual, and thanks for the startup nation narrative that Macron has put in place. It's incredible to see what's happening in there. But if you then drill down in value contribution, profit contribution, or kind of competitiveness, the answer is it's not doing much. So Revolut still is way bigger than any of the digital offerings. Trade Republic still is a massive threat to asset managers and stuff like that. So it's that the age of experiment is happening, but it's a bit late for just experimenting around. It should be more critical, and it should be a bit more money being put behind that in the bigger perspective of how big those players are. That's A. And B, the reality is it's going to happen anyway. So you either start understanding that deepfakes and deepfakes at scale are part of the game, and start training your risk management against that, or you're just going to be exposed. So the reality is that a student sitting in a room in Bangalore now has technology at hand that can do incredible stuff. So face it.
I have a final question for myself, and then you are released from the many questions. Thanks for that in advance. So that final question is economies of scale, concentration. In the tech industry, we see that few large players, because you need huge amounts of capital. You mentioned it yourself. You need huge amounts of data. The bigger you are, the more you have an advantage. Will the same happen in finance and banking?
To a certain degree, the answer is yes. So we already see that in retail banking. The more stuff gets digitized and the more customer access gets digitized, so once everything is software, to quote Mark Andreessen in there, it can be scaled and is a single pan-European retail bank with a market share across Europe of 40%, something that I can imagine? Yes. So and the lack of a digital single market, interestingly, is basically hindering that development from actually happening. So yeah, that can happen and that will happen. And then there's regulatory. Then there is non-existent cross-border synergies. There's interest. So in parts, we'll be seeing that. And if you look into the customer advice platforms, the mortgage platforms and stuff like that, there is market concentration already. Idealista, to just quote the Spanish, Italian, Portuguese example, captured the mortgage market in those countries to quite a bit. Check24, consumer finance, has a market share in comparison of 45% or such. So this is a concentration, just not with banks, but with the interface.
Okay. Thank you very much for your excellent presentation and for answering the many questions. It was really very stimulating. Thank you.
It's been a pleasure. Thank you.
We now turn to our two prize winners today. I think we start out, let me see, we start out with Thibault. Let me say a few words about Thibault before you start with your presentation. Please come here. Thibault Cézanne is currently a PhD student in economics at the University of Mannheim and at the research unit Pensions and Sustainable Finance Markets at ZEW, a major think tank in Germany. His research interests lie in the areas of monetary policy, banking, financial stability, and green finance. Prior to joining the University of Mannheim and ZEW, he worked at the Monetary Policy Research Division of the European Central Bank, at École Polytechnique, and at Natixis, so a true SUERF person, you know, combining all three areas. Thibault, over to you.
Yeah, thanks. I try to make this work. Not sure. Ah, perfect. Yeah, thanks a lot. First, does everybody hear me? I hope so. Yeah, okay, great. So thanks for attending this presentation. Thanks a lot for the prize. Both Frank and me are super happy about this. So Frank is sorry he could not come here to take care of his kids because his wife is away. But he was also thanking all of you. So today I will actually take another perspective from the very interesting presentations that we had before. So it's more like about how we can actually use AI to analyze actually what banks are telling in their press releases, and how actually what are the implications for the its own actions and also for the market perceptions. So compared to the planning, the title changed a bit. So now it's a bit more catchy. So it's like through rose-tinted or dark lenses, how bank manager sentiment affects lending and risk. Okay, so for all those who did economics, well, it's well known that sentiment has some an impact on economic agents' decisions. So think about Keynes' animal spirits. So it's really about like sentiment in the sense of something irrational, right? Some impulsion, some pulsions, etc. That has an impact either on your consumption or investment decisions. However, there is little which is known about how banks' investment decisions could be related with their managers' sentiment. So why is it important to study this aspect of bank managers, so their sentiment? So think about two extreme cases. So if you think about overly optimistic bank managers, then, well, you could just think that, well, if a bank manager is like super optimistic, even though the situation is pretty bad, economic and financial situation, well, this could have pretty huge and bad actually financial stability implications. Basically, it would lend way too much and take too much risk compared to what the situation justifies. On the contrary, if you have overly pessimistic bank managers, this would have some implications about the main role of the banks, which is just to finance the economy. Okay, so you have an economy that is going well, but still the bank manager does not want to lend and to take enough risk, which would have some consequences, and in particular would underfinance the economy. So that's the research question we try to answer in this paper. So is there some evidence for over-optimism or over-pessimism of bank managers, and is it related then to the bank lending, to the lending of the banks of those managers? So how do we do? So first, we collect earning press releases of more than 200 European banks from the first half of 2006 to the second half of 2019. So we get those from Standard & Poor's Capital IQ. So in total, we have around, I think, 3,000 press releases. And then what we do is that we calculate a tone score. So we try to measure how basically optimistic or pessimistic is the press releases, okay, of each of those banks. And to do so, we adopt two alternative approaches. So the first one is quite basic. It's a dictionary approach, which is labeled DICT here. So basically what we do is that we look at all the words of each press releases, okay, and then we match this list of words with an existing dictionary, a financial dictionary, which has been created by Lauren and McDonald, and which tells us for each of those words whether it's a positive word, so think about like booming or like expanding, stuff like that, a neutral word or a negative word. So negative word like recession or like reducing size or stuff, things like this. And then it's just a comparison of the share of positive against negative words in those press releases. Then the second approach, which is based on artificial intelligence, and which is actually much more sophisticated and state of the art, which is the machine learning approach. So what is this? What we use is an algorithm which is called FinBERT. And so FinBERT, what it is, it's just a machine learning algorithm which is pre-trained on millions of financial documents that you find on Google mostly, and then that is trained to detect whether a sentence or a paragraph is basically rather positive or negative. And so why is it better actually than the dictionary approach and more sophisticated? Is because with this machine learning approach, so the algorithm is able to detect actually like complex sentences. So whenever you have super long sentences with a lot of negations, or even some irony or sarcasm, the algorithm will be able to detect it and do a better classification in terms of sentiments, or positive or negative sentences. So this is a result we get from using those two approaches. So this is the average across all the banks at each time, okay? And so in gray you can see the two crises we had in our sample, so the global financial crisis and then the euro area crisis. So as you can see, the first thing is that so the machine learning approach is in blue and the dictionary approach is in red. So we have very similar results, okay, using both approaches. And for both we have something which is very procyclical as expected, right? So we have very positive press releases just before the crisis, and then you have a huge decrease during the crisis, and then a recovery, and as soon as the euro area crisis hits, again a small decrease, and then a recovery afterwards. So then what we want to do here, as you may have noticed about bank manager sentiment, so it's over optimism or over pessimism compared to the situation, the macro and financial situation. So what we want to study is really what is unrelated to economic and financial fundamentals. And so for this reason, we control for all the fundamentals we have, so both macroeconomics, so think about GDP growth, etc., and also at in terms of interest rates, and also at the bank level, so the business model of the bank, like its profitability, etc. And we focus on the part which is residual, so what we call the orthogonal part, this ORT, in the rest of the presentation. But the question now is, what is this orthogonal part? Is it something which is very irrational, so the sentiment we would like to capture, or maybe it's just private information from the bankers that they know from their clients that, okay, the economy maybe is not good today, but from what we heard from our clients, it will recover soon, so it would be a good reason for being optimistic. And to try to see what we capture, we do two tests. The first one is we check whether ORT is backward looking, so it's related to the past fundamentals and its own past. And second, whether it predicts better future bank financial performance. So the first test, which is backward looking, so we check whether the ORT is associated with past realizations of economic and financial fundamentals. So why it would tell us whether it's something forward-looking or more like irrational? Because if it's forward-looking, well, it means that you're a bit lagging behind, right, in your estimation of the situation. And so it has some, it's what we call extrapolative structure of expectations in academia. And so it's a proof of something irrational. And what we find is that actually the ORT today can be predicted by GDP growth yesterday, and also the actually ORT of the past. So if you were over-optimistic yesterday, you're still over-optimistic today, basically, which confirms the sentiment interpretation of ORT. Then the second test is with private information. So for this, we check whether ORT today predicts better future financial performance of the bank. Why? Because imagine it's private information, then well, you can assume that the bank which is more optimistic because its clients says, yeah, it will go much better, and then we could expect that in the future the bank will do better. And actually this is not what we find. We find no relationship or even a negative relationship, in the sense that we find higher art implies a higher NPL ratio, which contradicts the price information interpretation. So now we are sure that we capture sentiment. We study the implication on subsequent loan growth and systemic risk of the bank. So for loan growth prediction, we wonder whether like a bank which has a higher bank manager sentiment is associated with future loan growth. And the answer is yes, actually. We find significant results. So statistically and economically, we find that a 1 percentage point increase in bank manager sentiment is associated with an increase in loans by around 0.6% in the next 6 months. And in terms of systemic risk, so what we check is that we check whether like higher bank manager sentiment today is associated with lower or higher systemic risk of this specific bank. So whether actually the equity investor agree with the diagnosis of the bank, even though it's unrelated with fundamentals. And actually we find that the equity investors seem to consider the bank to be less risky if it has a higher bank manager sentiment. So the market seem to buy the story of the bank basically, and the size, so it's statistically significant, and the size is at 1 percentage point increase in bank manager sentiment is associated with a decrease in the S risk by 0.12 percentage points in the next 6 months. So just to wrap up, a small conclusion. So what we find is that bank manager sentiment is backward looking and not related with subsequent financial performance of the bank. It has we find that it has also it's associated with subsequent loan growth and S risk of the bank, so in the next 6 months, which has clear implications both in terms of financial stability and economic financing. Thanks a lot for your attention. Looking forward for comments and questions.
Thank you very much, Thibault. The floor is open for questions. Yes, please. You have a microphone. Yes.
Yeah, true. Sorry.
Thanks a lot. Very interesting. Again, I have 2 questions. Sorry for that. The art part. So what information did you use to strip out the systematic or the macroeconomic elements from the score you have been generating?
Yeah. So I will first answer the question, and then you have your second question, right?
If I didn't forget by then, yes.
Okay, great. So we used the GDP. We used, in terms of interest rate, we used the sovereign spread between Germany and Italy. We use also short-term OIS 3 months rate, and also we have put what we call in econometrics fixed effect. So whenever we could, we have put country, also a country fixed effect, time fixed effect, and country time fixed effect. So basically it's a dummy which captures everything that happens in your in a specific country at a certain time in your sample. So which is common to all the banks, and then you have variation across the banks basically.
Okay, thank you. And then a second question, the correlation to NPL ratios.
Yeah.
What has been the time lag you've been looking at from the more point in time where you calculated ORT to looking and checking NPL ratios?
So what I mean, the results I presented with NPL, but even the other ones we also control for autocorrelation. So we include the lags of actually ORT, but also the lags of NPL, and also the other variables I showed. I don't know if it answers your question. How much? We include I think 2 lags. So that we can control for seasonality as well, because we have half-year data. Yeah.
Thank you. Thank you. With one question here.
The second hypothesis that you had, was it significantly negative, or was it just randomly negative?
For so for the NPL ratio, for the which indicate?
If we could go back on the slides.
Oh yeah, sure. Yeah. Somebody. Yeah. Which test was it exactly?
The forward-looking analysis with the ORT.
Yeah.
You said it was, I'm unsure, was it significantly negative, or was it just randomly negative? Did you find a significance there?
So backward or forward looking? Sorry. Oh, yeah.
For the forward-looking one.
So the financial performance, right?
Yes.
Yeah. So actually, so that's why I say neutral. When I say neutral, it means like, I mean, it's never exactly zero, right? It's positive or negative, but it's completely insignificant statistically. And actually, the increase in NPL, it's something which is significant. That's why I've put yeah.
Thank you.
Final question.
Yeah. Thanks so much, Vatsala from the BIS. So maybe a two-part question. One, I'm interested in the implications of what you find, and related to that, I was curious about whether you find a correlation between the sentiments of different bank managers, because then that has implications for financial stability, right?
Of which manager? Sorry.
Of bank managers,
okay.
If the sentiments are correlated in some sort of systematic way, and what you think are the sort of the policy implications of the results you're finding.
Yeah, so thanks.
May I follow up on this?
Yeah.
And then we close. So my question, linking to the first part that you said, so human credit managers have behavioral biases. This is what I see from your paper. So should we replace them with AI algorithms?
Yeah, so actually, I think that could bring actually some, like sites on each bank, actually some like insights on each bank, and actually how strong is the behavioral aspect of each bank. So indeed, that's what I think. Now, having said so, now that I presented it to like a bunch maybe of bank managers, it's a bit the Lucas critique. Now that I told you that, maybe you will adjust your press releases and try to be super optimistic or pessimistic depending on what you want to the market or the regulator to believe, basically. So I guess the answer is yes, but we will probably need more and more sophisticated like AI techniques to really identify basically some bias. Yeah.
Thank you very much. This concludes our first paper. Thibault, congratulations to your prize.
Thanks a lot. Thanks a lot.
We now turn to Maximilian Goebel. Maximilian is a postdoctoral researcher at Bocconi University, university with which SUERF has very, very close cooperation and contact. Maximilian holds a PhD in economics from Lisbon School of Economics and Management. And your research focus is on climate econometrics, macroeconomic forecasting, asset pricing, and finance, with a strong focus on machine learning. Max, over to you.
Thanks. Yeah, thanks a lot for inviting us to present that paper here. So this is joint work with Philippe Goulet-Colombe from UCAM, and also he is very delighted for having been awarded that prize. So what the paper is about, it's maximally machine-learnable portfolios, and so basically what we're trying to do, you have a set of stocks, you want to see what is the optimal portfolio allocation of this set of stocks that is maximally predictable by some certain features that you might have. Any kind of features you can think of, any kind of explanatory variables that you deem important. What is the optimal allocation of that set of stocks to make a portfolio that is maximally predictable? That's what the paper is about. And at the core of that paper is an algorithm that I try to explain to you, but focus more on the empirical part, basically. So really, when it comes to forecasting stock returns, it's really kind of a sometimes disappointing endeavor. Out of sample R squares are very low, especially also in the modern machine learning literature, especially after 2000, mid-2000s, machine learning algorithms themselves really struggle to find any significant out of sample R square. But still, if you can find something, this is basically risk-adjusted profit, so risk-adjusted return. So maybe it's worth looking into that still. And maybe we don't have to find or have to predict each stock by itself, but find something, an allocation, a bundle of these stocks that is much more predictable. And this is what we want to set out here. The idea is not not a novel idea, let's say. So we built up on Lowe and McKinley, who proposed the maximally predictable portfolios in 1997. However, also limited by the time that they were living in. They were really very limited in the tools they had at hand. So they could only look at a handful of stocks. They only had linear models at hand, and they only also could look at very small set of features that they have. But maybe we find with modern machine learning tools much more predictability and build more powerful or more predictable portfolios. So this is a bit of a technical slide, but it's, I think, important to understand what's going on. I just want to give you the essence. So usually what you have is the first equation. You start out with, like, think of your Y as a time series, inflation. You want to predict with a set of features, predictors, that is your X matrix. It may be any macroeconomic series or any macroeconomic indicators you might think of. Now, you want to predict this single inflation target. You download it from Fred or from any statistics office or so. Now there was Breiman and Friedman who thought, like, okay, maybe it's not inflation itself that we can predict with our features that we have at hand, but maybe any nonlinear or linear transformation of the target that is better predictable by the features that we have. This was their extension. Our extension is now that we don't have a single target, but we have several targets. What are our several targets? It's our set of stocks that we want to bundle together. So this is essentially the algorithm setup that we have. We want to find a function G that bundles together the set of stocks that is maximally predictable by the function f of x using the features, the explanatory variables that we have at hand. And our algorithm here is kind of an expectation maximizing algorithm when you come from traditional econometrics. When you're more into the AI space, it's kind of a generative adversarial network, kind of. You can think of it that way. And it's an iterative algorithm that tries to, where we optimize the right-hand side, and then we go on to the left-hand side and try to optimize it based on the right-hand side. So it's an iterative procedure, always trying to make each side better. That's the idea behind that. Now, what is G and what is F? It can be anything. For G, we chose a penalized linear model, a ridge regression. It's a penalized OLS regression, kind of. F can be anything as well. We chose a random forest. Now, what is a random forest? A random forest is basically just, a tree. Let's say an ensemble of trees. So, as you see in nature, many trees. It makes a forest. What is a tree? You can think of a tree as splitting your time series into different regimes. You may, for example, think about the inflation example. You have at some point an instance where the central bank implements inflation targeting. You may say, well, before inflation targeting, inflation followed a different process than it followed thereafter. So you split your time series according to this implementation date to make a better forecast. Then you might have other variables and say, okay, before in the inflation target regime, before the inflation target was instantiated, when you then split according to economic growth being higher than, let's say, 0 or lower than 0, you have again a different inflation process. So this is what a tree is. It's splitting the time series into different regimes. When you build several trees, you arrive at the forest, and it's much more powerful than a single decision tree. Why is that so, or why do we choose a random forest? Well, it works tremendously well on all sorts of data. It also is better on tabular data than neural networks. It can be handled and disciplined much more easily than big blown neural networks, for example. So it's less prone to overfitting, which is very important in our environment of a very low signal to noise ratio. The last part here, this is just a reference to a slide that I'm not going to show in the presentation, but this is very important, I think, to understand that our algorithm really has analogy to the traditional mean variance optimization framework. So this is important for, let's say, asset allocators, for portfolio managers, to say that if we were using our algorithm, this is basically giving us very nice mean variance properties. So we're kind of optimizing the Sharpe ratio, risk-adjusted profits that we're looking at. Now we have two experiments here. I want to show the daily experiment. So we're trading at the daily frequency with 20, 50, and 100 stocks from the Nasdaq. These are the stocks that had the highest market capitalization on January the 3rd in 2017. Our out-of-sample period runs then until 2022, and we train our algorithm basically once over this period, and then trade it on a daily basis until 2022. Now that's a big slide. Want to point you to the takeaways. You have the out-of-sample R-square. So out-of-sample. This is data the model hasn't seen. What our model gives us is an out-of-sample R-square when we trade 100 stocks, it's 4.5%. When you look at alternatives like the equally weighted portfolio, there's nothing here. It's an out-of-sample R-square of 0. If you trade the S&P 500 with a random forest, it's 2.88. So our portfolio surpasses all the others by quite some margin. Then when you look at the out-of-sample annualized return, it's also much higher than any of the competitors. Equally weighted portfolio, which is supposed to be a very competitive benchmark, it's lower by vast margins. Also, when you look then at the risk-adjusted returns, like the Sharpe ratio here in all of our out-of-sample period, our MACE portfolio, especially in the case of 100, leaves all the competitors behind. This is just to show that, our model works. Now, what does the time series look like of cumulative returns? In red, you see our portfolio being traded at daily frequency, where our position in the market the next day is determined by the forecast of a random forest. In yellow, you see our portfolio where the position in the market that you take tomorrow is determined by the historical mean of our model's performance. So you see that the random forest is better than just using the historical mean, and it seems to identify certain regimes in the data. That's what I talked about in the beginning. Why a random forest? It's important. It can handle nonlinearities. It can determine different regimes. And this one single regime here was, for example, the crisis of the pandemic during March 2020. Now, what's happening here? Two things are important here, but for the sake of time, I just want to give you the gist. It is basically the mean reverting behavior at a daily frequency during crisis times that the model leverages here a lot. It really understands that a regime has set in where volatility is very high during a crisis, and that the stocks at the daily frequency show a mean reverting behavior, and it's leveraging that. It has learned that during the Great Recession, which is shown here. There's a similar behavior. Outside the COVID recession, there's nothing here. There's not really a statistically significant, or at least to a lesser extent, negative coefficient here. So this shows you that it really understands that a new regime has set in and that it can leverage the mean reverting behavior. There's some refinements here. You can make it a bit better. You can use some bagging strategies, which kind of tries to get rid of all the noise among the weights, so give you some more regularization of the weights, and so several refinements we talk about in the paper. Now, what is the broader picture? Well, you cannot only use it for financial markets. You can also build maximally predictable macro aggregates. For example, when you look at core inflation, it's a project that Philippe is working on, and another project that also Philippe is working on is about combining certain county or state level macroeconomic indicators using this framework, using this algorithm. Thanks a lot. Looking forward to the questions.
Thank you very much, Max. Are there any questions? Yes, please.
Thank you. Thanks a lot. Very interesting presentation. I was just wondering, the independent vector X that you're using, could you elaborate a bit on like what are the features that flow into this?
Yeah.
And maybe in connection to this, so that the time lag H that your equation is using, how did you optimize and how did you find the right setting for this?
Yeah, thanks. Very good question. So we run 2 experiments at the daily and at the monthly frequency. So I only showed you the daily exercise. At the daily exercise, yeah, we were really faced with the question, which features do we put in? And the features we put in here are basically lagged portfolio returns. So it's kind of one-sided moving averages of up to 21 days of lagged portfolio returns. It's kind of a momentum machine that we're using there. This is at the daily frequency. The lag is 1 day. So we try to predict the next day, basically, with these features. You can put in anything. The idea behind that was, if you want to do that or handle it operationally, having features at the daily frequency could be quite costly. So we want to recycle some of the data that we already have. For sure, you can put in any other indicators, other moving averages, longer moving averages, for example, or RSI indicators, the technical indicators that many look at. So we haven't looked at that, but that's definitely a field to explore. At the monthly frequency, we put in macroeconomic indicators. We predict also 1 month ahead at the monthly frequency, and there we have macroeconomic indicators from Goebel and Welsh. That's a paper in 2008, and they have certain financial macroeconomic metrics. For example, forward-looking 12 months earnings, stuff like that. It's a data set that is frequently used in the literature, for example. But you could put anything in there you may think of. Yeah.
Final opportunity for a final question. We turn to you and then you.
I noticed you excluded 2 days between training and testing period. I was curious why 2 days?
I don't think that it's excluded. I think it was just non-trading days.
Okay.
Could that be? So I think January is something. So I think it's non-trading days. Yeah.
Thank you.
Hi. As I understood, you're having here an optimization problem. So why are you using random forest, which is like for regressional classification and not classical optimization algorithms, such as evolutionary?
Okay. So what we're trying to do in each part, we're trying to predict the other side, right? So it's a prediction exercise. So you have the features and you initialize your portfolio with any random initialization of what your portfolio might be. And then you use the forest with the predictors and you try to forecast that portfolio, right? That portfolio return. Then you go on to the other side and then you get a prediction what your random forest will predict. Then you go on to the other side and use your rich regression to forecast the prediction of the random forest. Optimizing your weights by doing this, you get a new portfolio return on this, and then you iterate the algorithm going forward.
Okay.
So,
so
it's two-sided. It's an expectation maximization algorithm where you go, or where you optimize the one hand, and then you go on to the other setup, and it's both a prediction exercise for the left-hand side and for the right-hand side, basically.
Okay, interesting. Thank you.
Yeah.
I have a final question myself. So, relating to your to the data that you studied in your paper. So let's suppose, to what extent is this subject to the Lucas critique? So if many portfolio managers applied your algorithm, what would happen? Would it die?
Yeah. No, that's definitely something like in the factor industry, like someone develop or comes up with a new factor and suddenly dies out of sample. True. I would say not necessarily. There's so much you could put on your right-hand side as your features that the potential to explore it is just huge. You could put any features on the right-hand side and you may get a completely different portfolio out of that. Then you could substitute the random forest with some other machine learning algorithm you may think of, or not even machine learning algorithm. There are many tuning parameters involved in there to optimize it. And you might have an edge on something yeah, that creates a completely different portfolio. But the key really is, I would say, the input features and the set of stocks that you might be interested in. And many say like it always like the data is key, and garbage in, garbage out is with as always. So yeah.
Of course, but your reply would also imply that since there are so many possible variations, there is also not an immediate risk of herding and therefore of exaggeration of price movement. Right.
So I think that's the advantage of the algorithm, that there's given the data that you have, it's a conditional exercise. Given the data that you have at hand, and that data may vary from many diverse set of features that not everybody has access to, you can create a portfolio that is completely different, and you can exploit that. And I think therefore many different maximally predictable portfolios are possible.
Great. Thank you so much for your presentation. Congratulations for your paper.
Thanks a lot.
Best regards to Philip as well.
I will.
Once in Vienna 2 or 3 years ago.
I heard so. Thanks a lot.
Thank you. I may now lead over to our panel, led by Stefan Bruckbauer. May I ask the panelists and Stefan to the floor, and I hand over.
Please. Yes, now to the final part of this AI day, and now we come a little bit more down to earth on that, and I'm very happy to be here for several reasons. One is that my bank, and we long-time member of SUERF, and but getting older, one has to move from presenting to chairing. So I'm happy to do this the first time. And last but not least, I don't know anything about AI and banking. So I'm happy to learn a lot. And here on this panel we don't have, but we have it in hybrid form. We have a banker, Alessandro Barardi from Unicredit. We have a consultant from Oliver Wyman. We have a risk analyst from Standard & Poor's. And finally, a regulator from BIS. So we start with Alessandro, head of analytics and AI at Unicredit, and he leads and implements AI applications for decision making and efficiency. He has been awarded Marie Curie Fellowship and PhD in computational neuroscience in Spain and the US. He has worked in different research areas in Australia, Europe, and US, and started his managerial career building up the data science and then the AI global function at Unicredit. So Alessandro, the floor is yours.
Good morning to everyone, and thanks for the introduction. I'm very sorry for not being there physically, but I'm in Milan for other meeting coming in our company. So I'm leading artificial intelligence team Unicredit at the global level. So we're in charge of developing artificial intelligence solution for different areas of the bank at the global level. But today I will talk about the AI Act and what's going on, also to complement what our colleagues we are going to discuss during this panel. I don't want to extinguish the enthusiasm about AI, talking about the AI Act incoming, but just to give what's our view of what's going on, that we see it as an opportunity rather than an additional obstacle to the development and that scale adoption of AI in finance in general and within Unicredit. The Artificial Intelligence Act is a comprehensive framework designed to ensure that responsible and ethical use of artificial intelligence technology. But at the same time, and as we will see in a while, it's an opportunity also to foster innovation and while safeguarding the fundamental rights of humans. Its impact on the financial sector that we are seeing is both profound and far-reaching. As we delve into this topic, it is essential to understand the context in which the AI Act has been introduced last month. So the rapid advancement of AI technologies has brought about opportunities, new opportunities and challenges in the financial sector. AI has revolutionized operation, risk management, customer services, and now with generative AI, since 1 year, what we see is that we may have, actually we're already having immense potential in automating complex tasks, generating insightful data analysis, and also creating innovative product to some extent. However, with these advancements come ethical, legal, and societal concern that demand a robust regulatory framework. This act that has been introduced in April aims to address this concern by establishing a set of rules for artificial intelligence system. So basically, it categorizes artificial intelligence application based on their risk levels and will impose strict requirements on high-risk artificial intelligence system, including those one used in the financial sector. So the primary objectives of the AI Act is to ensure the safety and transparency of artificial intelligence system, and I said before also to protect fundamental rights and enhance trust in artificial intelligence technology. One of the most significant impact of the Artificial Intelligence Act on financial sector is the emphasis on transparency and accountability. So financial institutions rely heavily on AI-driven decision-making processes, from credit scoring to fraud detection. And under the Artificial Intelligence Act, as a bank, but all the institutions must provide clear explanation of how their artificial intelligence system work, ensuring that decisions are transparent and also understandable to both regulators and customers. And this transparency is crucial in building trust and also mitigating the risk associated with the artificial intelligence algorithms. Moreover, the AI Act mandates rigorous testing and validation of artificial intelligence systems before are deployed in the financial sector. And this requirement is particularly relevant for generative AI because it involves the creation of new data, models, new content. So by ensuring that this system undergo through testing, the AI Act expects to minimize the risk of errors, bias, and unintended consequences. And as a bank, as a financial institution, we must demonstrate that our AI systems are reliable, accurate, and fair. So enhancing the overall integrity of the financial system. Another critical aspect of the Artificial Intelligence Act is the focus on the ethical artificial intelligence development. So the Act prohibits certain AI practices that are deemed harmful or unethical, such as, for instance, social scoring or subliminal manipulation, for instance. In the financial sector, this means that artificial intelligence system cannot be used to unfairly influence customer behavior or, for instance, discriminate against individuals based on biased algorithms. So generative AI, with its ability to create content and models, must adhere to these ethical guidelines to ensure that financial products and services are developed and delivered in a manner that respects human dignity and rights. Another critical concept that as people working on the field, in the factory, developing artificial intelligence, we appreciate is the concept of the AI regulatory sandboxes, which provide a control environment for testing innovative artificial intelligence application. And for financial sector, this is a significant boost as it allows us to experiment with generative AI technology, for instance, without the fear of immediate regulatory repercussions. These sandboxes facilitate collaboration between regulators and innovators, so this way fostering a culture of responsible experimentation and accelerating the development of cutting-edge AI solution. And this is important for a company like Unicredit that wants to be leading this transformation rather than following. So the innovation part, the experimentation part is crucial in order to adopt a timely cutting-edge artificial intelligence solution. Last point, the AI Act emphasized the importance of data quality and governance. Financial institutions rely on vast amounts of data to train and deploy artificial intelligence system. As expected, the AI Act is requiring the data be of high quality, representative, and also free from any bias. For generative AI, this means that the input data must be curated and validated to ensure that the outputs are reliable and unbiased. In addition to these regulatory requirements, the Artificial Intelligence Act also promotes the development of AI skills and competence. So in this sense, Unicredit and financial sector is investing in training and upskilling the workforce to effectively leverage artificial intelligence technology. And this includes understanding the principle of artificial intelligence, the ethical implication, and also the regulatory requirements. As I was emphasizing before, the Artificial Intelligence Act encourages innovation by providing a clear and predictable regulatory framework. So we can confidentially invest in AI research and development, so knowing that there are well-defined guidelines and standards to follow. So I think that this regulatory certainty foster a culture of innovation and can allow financial institutions to explore the full potential of generative AI in creating innovative or new services, new products, and also improving the customer experience. The Artificial Intelligence Act also has the implication for international cooperation and harmonization of artificial intelligence regulation. This is for Unicredit that is present in 14 countries is key. So as one of the first comprehensive AI regulation globally, the AI Act can set a benchmark for other regions and countries to follow. So financial institutions as Unicredit that operate in multiple jurisdictions must navigate a complex web of regulation. With the AI Act, with this harmonized approach, can provide a blueprint for global AI governance, so reducing the regulatory fragmentation and also facilitating the collaboration cross-country, cross-border. So in conclusion, the Artificial Intelligence Act introduced by the European Union represents a pivotal moment in the governance of artificial intelligence. Its impact on the financial sector is profound and multi-phased. By emphasizing transparency, accountability, ethical development, and innovation, the AI Act ensures that AI technologies are deployed in a responsible way and in an ethical way. So financial institutions must embrace this principle and need to invest in building a robust AI system that complies with the AI Act for the regulation, but also because this way they can fully and timely harness the transformative potential of AI while safeguarding fundamental rights. And what is crucial for the bank, keep building trust with our customer and with our regulators. So the Act is not just a regulatory framework. We want to see it as an opportunity for the financial sector to lead also by example and demonstrate the responsible and ethical use of AI technologies.
For your insight into the practice, how to integrate AI into banking and its challenges. And now we turn to an advisor. Rainer Glaser is a partner in the finance and risk practice. He leads Oliver Wyman's EMEA Data and Analytics initiative and is a key expert in generative AI and quantitative analytics. He joined Oliver Wyman in 2010. He has worked with a lot of financial institutions in Europe with a focus on quantitative risk management, overall bank management, regulatory issues, advanced approaches to risk management and business management. And I'm looking forward to your presentation, which has a really great title, AI, Intelligent Enough for the Real World. So, Rainer, the floor is yours.
Thank you very much. I'm going to look at, I think, similar topics as Alessandro just mentioned. Shall I flick up the...
Yeah, you can walk over there. Is it the right one? Yes.
Yeah. So thanks for the introduction. That's a question I keep asking myself, and I keep coming across with various of our clients and the work we are doing with our clients. And AI is a big topic. I think that's not a surprise to anyone in this room. It became a huge hype following the introduction of ChatGPT, right? So the latest with ChatGPT, everybody started talking about AI, generative AI, and so on. There were different views, and I'm going to introduce a couple of personas in a second. But there's a big universe and a big spectrum of opinions about what AI can do in general for our professional, the private life, the financial sector's entities in particular. So there's, if you talk to people, there's a group of people which I call the doubters. It's a pessimistic group of people that say, well, this whole AI stuff is just a bubble, it's just a hype. It will go away in a few months and it's not going to change the world, right? And there's the opposite extreme. There's a set of people that are really visionary, that say AI, generative AI in particular, will change everything. Professional, private lives, workforce will change. It's going to be a massive efficiency gain. We will be able to reduce FTEs, for example, significantly within a short time frame of a couple of months, which I think if you do a bit of backcasting and sort of check when those opinions came up initially, you realize this is not going to happen, right? So AI, GenAI is older than a couple of months already. And it's fair to say that the methodologies behind are not new, right? So large language models have been out there for years already. It's neural networks in the end. Therefore, you could argue it's not new. What is new is the way how people can interact with complex methodologies and how they can eventually use the benefits of, pre-trained models that have a given understanding and given capabilities, and they can use it for their purposes. And then there's a third school that sits somewhere in between, that is the realist group, people that say there is potential of AI and generative AI, but it comes with a price. So this potential we can harness, and we do want to harness, but it's not like we just push a couple of documents into GPT-3, for example, and then we're going to realize the impact and harness the benefits that these methodologies can bring, right? So I fall in one of these three schools. I'm probably going to reveal which one it is as I walk through the next couple of pages anyway. But I did a bit of an experiment. So we have GenAI capabilities internally running in our systems. We use it for internal purposes, but also for client purposes. I was prompting, and this one is GPT, I think 3.5 based. I was prompting one of our machines and said, what do you know about these three schools? So the pessimist, the realist, and the visionary perspectives. It was answering, like it was describing these different schools, but it came back with a quite trivial knowledge. So things and elements that we all know from news, from public media, from social media. So this was not really enlightening. So I was quite skeptical after asking those questions. I just was trying to push it a step forward. I said, can you tell me what is your expectation about what's going to happen? Is it going to be 1, 2, 3? So is it a bubble, or is it going to change the world completely in a couple of months, or is it somewhere in between? And well, it's not a surprise it didn't answer. Yeah, it was winding its way around this as a consultant does sometimes. It basically says like all three scenarios are possible, and the outcome depends on a lot of things. So maybe we don't know. So it was not really helpful in that scenario. So but I was playing around a bit further and said, look, even if we don't know what's going to happen, can you show me the life of a normal family 10 years down the line, assuming it's a bubble, or it's going to be a big bang changing everything, or it's somewhere in between? It did. It was giving me some nice pictures. You can see it has a specific view about how a family would look like in the future, about how many pets are there, how many children they would have. I think there's a bit of differentiation. Who does the cooking? I think it's in two cases it's a husband taking over the preparation of meals, and in one case, in the traditional case actually, it's the wife preparing the meal. There's a bit of differentiation around like how people are using technology for communication. You see quite some fancy gadgets in the visionary world, right? Some avatars, some holographic means of communication. So it's quite clear that the machine thinks that technologically there will be changes, or there's a differentiation between those three scenarios. Yeah, but ultimately also this one was not really, it looks nice, but it was not giving me the biggest insights. Yeah? And then I was asking it to explain a bit more, and again, we don't need to read all the explanations here. It is summarizing what's written on those pictures, and in some places it even gets it wrong, right? In some places you find the description about these forecasts and the scenarios it was painting is text and pictures are not consistent. Yeah? So I said it does something. It is able to paint pictures. It is able to produce language, and that's what these things are trained for. They say we can generate some content, but in this example, it was not really helping me with the answer I have been after. That's why I said maybe it was too broad. Let's look into a more specific example. Let's talk about, and I come from the space of risk management. I've been doing a lot of risk management, quantitative risk management in the past. I said, can you explain me how an AI-based credit risk engine would look like? Again, I got a fancy picture. So the left-hand side on this page, it looked nice, but somehow I felt like it's a bit of generic, high level in the best case. So I did a bit of prompting. I was feeding it with more information. So what it did, it was making the thing look more technical. There's a lot of screens in the second version, and there's a lot of things that look like formulas, but even if you zoom in, those formulas are not readable. Right? Again, a bit of prompting didn't help this thing to really understand what I was asking for. So I didn't really understand what it means, or what the request would mean to tell it, can you explain me what an AI-driven credit engine would look like? Yeah, and then the visionary might say, okay, this was a bit of amateurish approach, right? You have been playing around, you've been doing some simple prompts, so I took it a step forward. I was feeding it with literature about credit risk and credit risk modeling. I gave it a task that said, can you produce a piece of code that would be generating a PD model? It did. It gave me a piece of code. This was running, it was syntactically correct. It was you could say it was producing a PD model, but this was trivial. It was not really useful. Yeah. So syntactically, there was a piece of code I could run. There was no mistakes, but the content behind and the usability was really limited. Yeah. And this is why my view is I'm in the middle. I'm the realist. I say there is potential. Yeah. There's a lot of things we can do with the new methodologies, and we've been doing so for years already, but there's something we need to do. So we need to learn how to use it. We also need to understand what it can do versus not, because coming back to the earlier point, it is a large language model, for example, is a language machine. It's trained to produce language. It's trained to give you an answer. It's not trained to have reasoning, at least not in a generic setup, to have any sort of reasoning about what's the right answer. It's giving you the most probable answer with a notion of probability that comes from its training task and its training world, right? Therefore, we need to build out our capabilities as well. We need to learn how to fine-tune, for example, the existing methodologies to be bespoke for a certain use case. For example, the credit risk use case, I need to train a large language model to understand credit risk before I pose questions about credit risk, right? And then this is connected now to what Alessandro was saying. We can't afford these things to be a black box. And there's a requirement, a regulatory requirement from the AI Act that says it needs to be transparent. You need to be able to control it. But this is, from a practical perspective, is one of the biggest challenges. So if I want to use these methodologies at scale and want to harness the full impact, it needs to be transparent to me, and I need to be able to control it. Otherwise, double checking, for example, monitoring whatever it is doing, will jeopardize the benefit and will jeopardize the efficiency gains. Yeah? Therefore, my point of view is it's great. There's a lot of potential there, but it's going to take us some time to realize this. And it comes with a price. We need to learn how to use it, and we need to train these things to really understand what we're asking them to do. Thank you.
Yeah. Thank you very much for your down-to-earth view on that. And this is also my experience I had before this event. I asked ChatGPT, should I wear a necktie for this event? And I asked it's an event about AI, and it said no. And then said it is in a bank. Then said you should respect the bank and use a necktie. So it was also the same. It was not fully clear, the answer. So before we move to the regulatory part, we will have a further look on risk. In this case, somebody who is looking at risks in her profession. Miriam Fernandez is a director in the Analytical Innovation at Standard & Poor's Global Ratings. She is based in Madrid, specialized in AI research. She co-leads the AI Insights Research Laboratory and has written a lot of articles, including on AI in banking. Miriam has 15 years of experience covering European banks as a rating analyst, and prior to joining Standard & Poor's, she worked for 2 international investment banks in London. So the floor is yours from the risk perspective.
Thank you. Thank you very much. And it's a real pleasure to be here in person with all of you. And just to give a bit of background, when I was a rating analyst at S&P Global Ratings before joining my new team at Analytical Innovation, I also did some research on the future of banking and future of digital transformation for the sector, and we usually engage in a lot of conversations with the banks we rate in that respect. And that has brought me slowly to start learning more about AI. But I still consider myself relatively newbie. And I wanted to do a little exercise here with those of you that are here in person. And we can exclude from my survey the people who work daily with artificial intelligence and algorithms. But could you please raise your hands if you have done training or course on AI over the past few months? Okay, so maybe 50% of the room. And this makes me think that we are sort of in a honeymoon phase with regards to generative AI. We basically started to learn about her, saw the beautiful things that AI could bring to us, decided to go ahead and marry her. But now it's about time that we really start to know her well. And for this reason, a few months ago, we decided to launch our website, Artificial Intelligence Insights, which is free of access for everyone. And the idea behind is to democratize the learning on AI, particularly for market participants and people that are not working daily with algorithms and machine learning and so on. And we took a different approach than usual. Usually we would provide S&P Global views to the market, but this time, because this is such a new topic and we are all learning from it, we decided to invite market participants as well into the conversation. And we have been doing that for a while with our podcast, and I included the QR codes here for the webcast and the podcast in case you're interested in looking at that later. But the idea is to collectively advance the conversation into a more mature conversation, particularly with regards to governance and risk as we move on. And one of the articles on the website is about artificial intelligence in banking. I'm not going to go through the whole thing, but I wanted to give you some key highlights, because we usually approach the conversation by looking at the opportunities and the risks that AI can bring to a particular industry, in this case, the banking industry. And we went a step ahead and thought, okay, going forward, I mean, right now it might be still too early to see an impact on the credit ratings of banks from their deployment and their use of AI. But in the future, in a few years from now, how could that impact look like? And we came up with this idea of, it is a combination of intrinsic capabilities plus external factors that also influence, in the end, the credit quality of banks. And if we focus on the internal ones, in particular, the first one, business competitive landscape, here we can see that, for example, banks have chatbots, generative AI chatbots at the moment that can help solve some queries and help with financial health and financial literacy. But we're also hearing from the banks that we rate that in a few years from now, they are expecting to develop much more personalized banking services and products, all powered by AI. So what this means is that if you put AI strategies together with AI governance frameworks, and all of that, those two things are consistent with the business model of the bank and the plan that the bank has for the future, then it could lead to better productivity on the employee side, but it can also lead to better customer satisfaction and in the end, better customer loyalty. And when you look at that from the ratings perspective and from the credit angle perspective, that translates into more stable and more resilient business franchises going forward. And it could develop into some competitive advantages for those banks that are leading the race. Now, the second intrinsic capability is more numerical. It's about the financial performance. You know that we are we are financial analysts, and we focus a lot on the efficiencies and returns of the banks on a forward-looking basis. So here we see a dual opportunity, both on the revenue angle and on the cost savings front. I'll focus more on the cost savings because I think here it's where, at least in the short term, we see the biggest benefits. And the economist Daron Acemoglu has been calling for some time for a shift in AI that goes from automation into human enhancement. And we think that we might be going into that direction with generative AI because of the capabilities that it has around natural language and the fact that it can be more useful in jobs that require higher linguistic and mathematical skills, like those in the banking industry. And there is a recent report from KPMG and the City of London that illustrates that on a forward-looking basis. It basically says that for support functions in the banking sector, those mainly related to HR, IT, operations, and so on, the improvement in productivity over the next 5 years could be close to 60%, or 58%. So it's quite substantial. But, I mean, putting back the risk lenses, we see that there are some intermediate challenges for these productivity gains to materialize. And the first one is that, of course, it's not going to be an imminent gain because there is going to be a lot of capex. There is already a lot of capex that needs to be absorbed before it can be positive on the bottom line of the P&L of banks. And the second challenge, we have been alluding through the whole morning, it's about talent reskilling. It's going to take time, and it's definitely not only a change of learning, but also a change of culture for banks. And the third intrinsic capability is about risk management. And here, the way we see it is as a two-edged sword. Because on the positive side, if banks develop well their AI models, it could result into better credit, market, and liquidity risk management through, more comprehensive and decision tools that allow lower non-performing loans and lower probabilities of default. But on the other side, if it's done poorly, it can lead to very relevant operational risks, financial harm, and very importantly also reputational risks. And all of this is just considering the internal capabilities of banks, but of course banks are playing in an ecosystem. So we thought that it was also relevant to highlight the fact that there are other factors and parties that can influence banks' credit quality in the future. And those are namely the fintech ecosystem and the big tech ecosystem, because so far we're seeing that banks tend to engage in this hybrid model of buy and build AI and technology. Also related to regulatory implementation. I know AI is going to help a lot in that front as well, but so far until we get there and we can automate regulatory implementation, it's definitely going to take a toll on banks' P&L, and banks will have to dedicate a lot of resources to be compliant. And last but not least, third-party risk. And here I think it about two ways. On one side, we have the actors with good intent. So we can imagine just third-party vendors, which can be a channel for risk for banks through, AI amplifying capabilities for attacks. And on the other side, we can think just also about malicious actors that will have more capabilities going forward. So with all of this in mind, how do what tools do we put in our suitcase so that we can identify whether the relationship between banks and AI is going to survive the honeymoon phase and it's going to result in a long-lasting marriage. Well, as Christoph was talking this morning, he was referring to the known unknowns. I think this would be my known unknowns, but taking a more cautious approach from a risk perspective. And basically, the way the key factors that we are looking forward relate to the evolution of AI strategies and governance frameworks. Our sister company, 451 Research, has a survey that says that around 40% of financial services companies already have an AI strategy. 40% is quite a large number. So I think banks are doing their homework on that front, but more to come. The second factor is about human capital. And here I alluded earlier to the internal reskilling, but I think we need to also consider customer preferences that are completely different depending on the jurisdiction and on the age. So banks will, I think, have to adapt and push either the brake or the accelerator to also be capable of serving those customers and not leaving the more traditional ones behind. The third one is very relevant in my view, and it is about digital operational resilience. Because with AI capabilities pushing the accelerator for potentially higher cyber attacks, it will be very relevant for banks to have the operational guardrails to be able to be better positioned to face the storm. The Digital Operational Resilience Act, DORA, already is a step in that direction. And the final factor, it's a combination between the risk approach, which what we're seeing, it's a risk-based approach. So, which means that those use cases that are of higher risk and, for example, involve private customer data are going to take longer to move from testing into being fully scaled. And then combining that with the human oversight. And here we're seeing a bit of a tandem. We're seeing that some banks are playing a more aggressive role, more innovative role in like trying to have generative AI tools that can interact with customers, whereas others are trying to keep the human oversight behind. And it might not result in that higher cost savings, but it's definitely a cautious view to take going forward. So the most important thing I'd like you to remember today is that we think that the benefits of AI in banking are likely to be gradual and incremental. It's not going to happen from one day to another. And beyond the hype, with the banking industry being regulated and also trust-based, we think that it's important to highlight the relevance of having a risk-based approach and human oversight through the process as we learn more about the technology. Thank you.
Many thanks. My feeling is that the longer the event lasts, the more skeptical the presentations are. We started quite optimistic on that task, and I would be surprised if our last presentation would be surprised on that, because normally regulators are more cautious. So now we turn to Vatsala Shreeti. She is economist at the Monetary and Economics Department at the BIS. She joined the BIS in September 22. She is broadly interested in empirical industrial organization and digital economics with a focus on economies. She is also research affiliate to CES-IFO and the Financial Inclusion Through Interoperability Initiative. She obtained a PhD in economics from the Toulouse School of Economics 2 years ago. And yes, we're looking forward to your presentation. Up to you if you want. No problem. If you can handle. I'm not very good in handling two things at the same time, but
okay, can I start? Great. So it's a great pleasure to be here. Thank you so much for having me. So it's useful that I'm doing the last presentation, because what I'll do is give you a bird's eye view of the importance of AI in finance and banking in the next 10 minutes. And so this what I'm going to present is going to be based on some joint work with colleagues at the BIS, but also at the University of Virginia and the University of Oxford. To understand the importance of the recent developments of AI in finance, I invite you to take a step back and think about the role that the financial sector plays in the economy. So essentially, the financial sector, what it does is that it takes dispersed information and from all over the economy, and it aggregates it or transforms it into informative price signals. And these price signals are important to allocate scarce resources across the economy. So that's really the role of the financial sector over time. So we view the financial sector somewhat as the brain of the economy. It enables efficient flow of capital, it manages risks, and maintains liquidity. So in a sense, with this backdrop, it is not surprising that the evolution of information processing technology like AI has gone hand in hand with the evolution of commerce and finance in general. So take, for example, we go back far in history to see this intricate relationship between finance and the history of information processing. The ancient Sumerians actually developed the abacus, one of the earliest computing devices, to address financial needs. When you go to the legal side, the Code of Hammurabi, which is one of the earliest legal edicts, it laid out laws in part to govern financial transactions. Move a bit forward in history. We have the very important innovation of double entry bookkeeping in accounting that greatly expanded commerce and finance. So the bottom line here that is important to keep in mind is that the history of computation and information processing is intertwined with the history of commerce and finance. And this is sort of translated also in the modern era. So the journey to modern AI started with in the 1950s with the advent of computers, and even back then, the financial sector was one of the first to adopt and use the earliest computers. In fact, the IBM 650, one of the earliest computers, was so popular in part because of applications in finance. And then we had good old-fashioned AI, which was based on simple rules and some data and generated outputs. And this was also adopted in finance and shaped technology development, both in finance and the tech sector itself. So an example of this would be index funds, right? So GoFi or rule-based export systems led to new products like index funds. Now, since the 2010s, machine learning has been quick to be adopted in finance. So in a sense, what we're talking about today is not really new to the banking and finance industry. Like, these technologies have been adopted quite a bit. And here, the limitation in the early 2010s was that computation power was much less than what we have today. And finally, as we've spoken through the morning, the newest sort of toy on the town is generative AI. And here we see vast potential, but do we also see new risks? So the rest of my talk is going to kind of be based around the opportunities and challenges that each generation of AI has made possible for the financial sector. So we're going to discuss like I said, the emerging opportunities and challenges of AI in banking and finance. Then we're also going to talk about the relationship that progress in AI has with financial stability, and the role of the real economy in the financial sector. So what is going to be the role of spillovers from the real economy, from the use of AI on the financial sector? And finally, we end with just a small discussion on how the financial regulation needs to be adapted to ongoing advancements in AI. Okay, so let me give you a very quick sort of overview of what we see as a summary of the opportunities that information processing technology, like AI, has made possible in finance. So even if you start with traditional analytics, there were already several applications of traditional analytics across the financial sectors. It led to greater competition. It was used for risk management, portfolio optimization, as well as algorithmic trading. In payments, it was used, in the payment sector, it was used for fraud detection. Then we moved on to the machine learning sort of advancement, and this unlocked really a lot of opportunities for finance. Credit risk and insurance risk analysis became much more sophisticated. It led to a lowering of underwriting costs. It expanded financial inclusion. Now we have sort of robust evidence showing that machine learning algorithms actually have a positive impact on financial inclusion. And same for other sectors. So there were new liquidity management tools, fraud detection, and AML became more sophisticated. And finally, with generative AI, we're already seeing firms in the financial sector and banking adopt it. And here the gains, like mentioned by Miriam and others, are going to be incremental. We will see enhanced credit scoring. And the real power is going to come from imposing structure on unstructured data. So suddenly a lot more is going to become legible, and that can enhance existing risk analysis methods, that can enhance compliance, customer service, and so on. However, nothing is free, and so the next slide is going to be about, about challenges. Or the risks of using AI technologies in finance. And here also we take a historical perspective and we start from really what was happening with traditional analytics. What are the risks that we already know of? So the challenge of using traditional analytics in finance came really from the smaller models, the small number of parameters. They were rigid and they required a lot of human supervision. But note that even with these limited capabilities, traditional models based on traditional analytics still were associated with flash crashes and had important implications for financial stability, which I'll speak of very shortly. With machine learning, some of these risks became more sophisticated as the opportunities did, and some of these have already been mentioned. So I highlight just a few important ones. So for example, the fact that we don't understand what these algorithms actually do is a big challenge. So the black boxness of the algorithms. Algorithms have also been shown to discriminate and carry forward the bias that exists in the data that they use. And there are these new challenges for how the data is actually used. So challenges to consumer privacy, emergence of data silos, and so on. Finally, with generative AI, we think of these challenges getting exacerbated in some ways. The fact that these models hallucinate, and that's a feature, not a bug, in customer-facing applications can be quite a big limitation. We also spoke earlier in the day about garbage in, garbage out. These models are only as good as what you put in them, how you prompt them, what the quality of the data is, and so on. And the last risk that I would say is that we didn't speak about today is really market concentration. Who is providing these services? Are we all reliant on the same third-party services? Who controls computational power? Who controls foundation models, cloud computing resources, and so on? So these are sort of things that we should think about. Let me then move on to broader risks, so systemic risks that arise out of AI use in the financial sector. So like I said before, early rule-based systems were already important for financial stability. For those of you that recall, the 1987 US stock market crash in part happened because of these rule-based export systems that had sell orders at a particular sort of benchmark, and many institutions were using the same type of export systems, which eventually led to the stock market crashing in 1987. So what machine learning does is probably increases these risks, because a lot of machine learning algorithms probably use the same data, they use the same models, and the reality is that in the real economy, we're just far more interconnected now. So there is also a simultaneous increase in network interconnectedness. Finally, with GenAI, all of these problems do exist, but there is something more. So I already spoke about the third-party dependencies, which essentially, because of market concentration, creates single points of failure, which are bad from a financial stability perspective, but also from an operational resilience and cyber risk perspective. But there is also the fat tail problem, which is that with GenAI, essentially you'll have lots of alternative data available, which will go into models. And the alternative data may not be representative, may be very short in terms of the length of the time series. And then the predictions or analysis that you do based on those models may not really be accurate. The last risk that I will talk about to the financial sector comes really from the real economy. So here, I'm going to show you two scenarios, essentially. So one in which AI adoption is a positive productivity shock. It leads to increases in productivity, and it doesn't lead to substantial labor market disruptions. The disruptions are self-contained and small. And so this will have limited sort of financial stability concerns. This is a nice Goldilocks sort of scenario. And so this is the optimistic scenario. On the other hand, what could also be possible is that if technology progresses very fast, if you get artificial general intelligence, or if technology progresses in a way that it replaces human labor a lot more than it enhances productivity, there might be massive labor market disruption, redistribution of wealth and income, which will then lead to defaults and financial instability. This is more the disruptive scenario. The truth is that we might land somewhere in the middle, and the bottom line would be how we react in that case, right? Are we prepared for it or not? And so that's the perfect time to take me to the last part of my intervention here, where I'm going to briefly tell you how we think about regulation. So is there a need to upgrade financial regulation for AI? I think yes, and this should be based on certain principles of AI regulation, some of which have already been spoken about before with the EU AI regulation. And what I'm showing you here will be based essentially on the EU AI Act, the interventions in the US and China. So basically, AI should be regulated in a way that takes into account social and environmental well-being, transparency and accountability, fairness and privacy protection, safety and human oversight, and finally, robustness and reliability. What is happening in action right now? So there are several approaches to regulating AI that are coming about, and we can classify them in broadly 3 buckets. One is a market-driven approach with a focus on self-regulation and prioritizing innovation. Then we have a state-driven approach with a focus on political objectives, on developing technology to achieve political objectives, and export, in the end, the technology itself. And finally, we have a rights-driven approach with a focus on individual and social rights. So technology development has to be sort of consistent with that. And this goes back to the keynote in the morning. Depending on what the ethos or the principles of where you find yourself to be, the regulatory model is going to look different. But what is important to note here for us as people working in this field, whether in the private sector, in central banks, or in universities, is that these approaches are not mutually exclusive. So we should think about kind of harmonizing them, which takes me to my final point, which I also think is the most important one, which is about international cooperation. So both the opportunities and the challenge and the way in which AI technologies are developed is pretty global in nature. So you would only, it's only obvious that you would require global cooperation on AI. And here, you have to be more tangible than just saying you need global cooperation, but cooperation on what, for example? So there might be a need to harmonize regulatory standards and governance rules, and also to have a transfer of knowledge between different regulators, between different practitioners, and have some uniformity in risk assessment. Because the bottom line is that you don't want to be in a situation where risks and opportunities are sort of regulated differently, and you want to prevent regulatory arbitrage. I will end here and be very happy to take your questions later. Thank you so much.
Thank you very much, not only for showing us the risks, but also the opportunities of AI. And yes, first of all, I would give you the possibility to react to each other if you want. So I would start, is there any reaction from you to these presentations? If
I can maybe go ahead. And I hope Alessandro is still with us, right? On the, even though we are not seeing him.
Yes.
Okay, yeah. We hear you. That's good. So I was wondering, while you were talking and mentioning AI sandboxes for innovation. So where are you seeing more potential right now for action in this front?
Okay, so first of all, as I was saying before, I see this an opportunity to not slow down innovation and experimentation with generative AI. In terms of where I see more need to experiments in AI, I can bring just my experience in Unicredit, and I want also to do a comment on what has been said so far. So as an expert of artificial intelligence and looking around what's going on, I think that we are slowly moving towards a new conversational banking model. Maybe this is kind of a strong statement, but even if we are not moving, we think that our customer tomorrow will ask to go in that direction. So what it means is that our customer tomorrow will expect to have a conversation with the bank that is real time, that is automated, that is open-ended, that is data-driven. So we are not there. We don't know where we will be there. Last announcements also on the market from the agreement between Apple and OpenAI. Now, they are saying us that if there will be a new smartphone revolution, so meaning that everyone will start pretending to conversate or interact with an engine, asking for whatever it needs, and the set of agents will employ different skills in order to set the specific answer for us, I think that the bank, because of what our customer will expect from us, will require. So having said this picture that may happen during the next years, what we are experimenting is where we can start in order to go in that direction. And what we are currently doing in a concrete way with experiments and now with solution ready to go in production is to start from employees population. So because now thinking about generative AI customer facing application, there are so many risks that at the moment are not under control. So we can start from building this conversational interface within our population In what sense? Starting providing them interface, conversation interface for informative action. The next step will be for dispositive action, and then moving step by step once also we know better the technology towards the customer. To give you a concrete example, for instance, in Unicredit, it's going to be live a semantic search engine for getting information in a very easy, seamless, and intuitive way. So we move from a keyword-based search approach to a semantic one where we can conversate human-like with an engine. So we increase the probability of getting the answer at the first iteration with the reference documents, and we do it 4 or 5 times faster what we see. So the benefits and the impacts are very significant. Now we need to see step by step how we can move forward from informative action like this to dispositive action, where as an employee I can ask the engine to do something for me, and then step by step we will see what will be the road for our customer.
Thank you.
So there are any questions from here? So maybe I turn to the to you. Are there? Yes, please. Please say your name and so that we.
Yeah, our Schubert, Vienna University of Economics and Business. I have a question to Vatsala, to your last point about international cooperation. I mean, since this whole area is obviously a very competitive area, and so the interest might be very diverse. And if you look at the new geopolitical reality, so how realistic is international cooperation, and do you see any really happening? So we heard that the industry, etc., is moving very, very fast. Is there a chance for international cooperation in the regulatory area here?
For sure, yes. So the BIS, for example, we're not a regulator, but we provide a platform for regulators to come and talk to each other. And one example is central banks. Central banks do often communicate with each other and harmonize on these things. So there is a remarkable opportunity to come together. And I think I speak of it as an opportunity because we're still at the nascent stages of adoption of these new AI technologies in the banking and financial sector. So I would say yes, even given the geopolitical scenarios, I think central banks and international institutions recognize the risks and the need to come together on these issues.
I think, another example is also from the World Economic Forum on the AI for Good initiative that is congregating various international organizations, right? Like I believe the IMF and the United Nations are part of that. And there is quite a lot of learning going on available for everyone on that platform that is quite interesting, also fighting for social inclusion and equity.
And sharing data, and that's also pretty important in these sort of debates. So there is a lot of thinking going on how to share data while preserving privacy and so on across borders. So there is a lot happening. It's a difficult process, but there's a lot happening.
Actually, I have 2 questions. So the first one is for Dr. Shreeti. So about competition, actually, I mean, we could go in that direction, as you said, but could it also lead to actually some monopolistic power, kind of, with, I mean, you worked on I/O, so at least in the tech industry, like in the US, there are those superstar firms, right, with Amazon, Facebook, Google. So could the same happen actually, about this artificial intelligence in banking? And so, isn't there a risk of just, very big banks just buying all the like small tech company in like financial services and just, actually threatening competition? And yes, I don't know if I should ask both questions or like you answer first and then the other one. The second one is for Mr. Glaser. So about the this thing about let's see what's happening in 10 years. So I mean, I agree with you. Like the main path is like, well, there are a lot of scenarios possible. At the same time, if I think about like where we were standing 10 years ago, I mean, honestly, I would have never bet that we would have been able today to do so sophisticated things with AI, like, like make ChatGPT write a fully correct code or like answering questions, doing deep fakes even. So actually, don't you think that there is, I mean, the growth of AI is kind of exponential? And so that in 10 years, actually some things that we think are very, like hard, like strong limits will just be very quick to overcome.
Okay, thank you so much. So two-part answer. So you're absolutely right. There are concerns of competition in this sector. So the ones that I will speak to are more coming from tech, right? From big tech. So across the sort of the AI supply chain at every stage, like I said before, if you start already from semiconductor production to GPU production to cloud to foundation models, each of these markets has clear sort of market power. There are a few companies that are operating across the supply chain, and that leads to a host of concerns, not just for financial stability, but also obviously for competition policy. On banks exerting their own market power on smaller tech firms. Here, I'm not sure, so the evidence is not unanimous in the sense that there is now work showing that banks partner with fintechs to gain a competitive advantage, but banks also partner with fintechs to expand efficiency, for example, and leverage their capabilities in using tech. So there is both the substitutability story and the complementarity story, and I don't think the jury is out to know which one is the sort of the dominant one. But it's a very important thing to look out for.
Yeah, and then happy to take the one on exponential evolution. I do think it's going to be exponential. I think the slope is maybe a bit slower than some people would have forecasted, but it will be exponential. It has to be, because it's a technological, not saying step change, but it's a technological progress that will pay out on an exponential basis, right? So this is clear. So to give you one example, I'm working a lot in the space of NLP, large language models, and so on. If I think back what I've been doing around NLP like 5 years ago, or even 10 years ago is even more striking, right? Dealing with keywords and dictionaries and stuff. Now using transformer models, it's no comparison, right? The good thing though is, and I think this is coming through in a lot of conversations as well, I think the whole hype also was generating quite some awareness, especially in the financial services industry, to say, there comes a risk with the opportunities we have, and we not always understand the risk in all places, and we do need to be cautious, because we can generate, and we will see more examples of failures than we have been seeing, but this is, I think it's a bit of a slowdown element, which is, for me, it's the right one, to say we're not doing everything that we could be doing, because we do want to do things in a controlled and understandable fashion. Therefore, you could accelerate further, technically and technologically, but I think we found a good balance, given where we stand. Another component, another contribution is we're not at the end of the evolution on the tech side of things. These models will continue growing. Computational power will grow. We mentioned quantum computing in the morning. It will continue, therefore it's definitely, it's an exponential growth. But as I mentioned earlier, I think we need to be able to digest and manage the exponential growth and optimize the slope that the growth curve might go through.
First. Thanks. Yeah, I might have a question for Miriam. From a risk analyst perspective, let's say, yeah, you can use the large language models or any kind of machine learning tool to analyze, let's say, company reportings and all that. But now companies know that risk analysts use that, so they will game their reports, basically. How do you see it? Are these models then even useful, using them? Are they, because I don't see them making a risk analyst then redundant in that regard, but are they of any use then if companies can game it, using greenwashing for the ESG scores, for example? Just an example. Yeah, just curious how you see that.
Yeah, I do agree with you that I don't think credit analysts are going to be replaced, but what I think is that there's going to be a combination of knowing how to use those LLMs, and when you were alluding to the financial companies, balance sheets and so on, like some financial statements come in already some kind of structured way that has to be reported for regulatory reasons in that way, and that will prevent companies from manipulating something that has a format. Whereas there could be also some structured data, and I think this is a challenge for banks, the unstructured data and using the LLMs and the generative AI tools on the unstructured data. But overall, I think it's going to be a combination of using more AI, more generative AI and robot process automation, plus having the analysts behind understand where there could be bias that could be introduced by the model, where there could be hallucinations, plus doing the job that they have always been doing. So in the end, keeping a critical analytical mindset to it.
Maybe just to share an additional thought on this one, because I think it's quite similar to the space of credit assessment. We're doing a lot of work there, and some people, so we're talking a lot about automated generation of credit memos. So some people misunderstand this as something that is writing up a report that based on information somebody else has been producing, right? So, but that's basically just the last step. The first and maybe the more difficult step is really use AI, generative AI, large language models to get the facts together, right? To really prepare the underlying rationale for a credit decision or for an ESG report, ESG scoring, whatever, such that it can be fed into an automated report, right? And the first step in particular, that needs to be transparent. Yeah, in a lot of places you find there is a human in the loop, sort of. So somebody will check whether whatever structured assessment the machine has been producing looks plausible, right? It needs to be traceable, because if I want to understand in the ESG scoring space, for example, why is the score for a certain category 5? I need to be able to drill down, and if needed, I need to be able to get to the ultimate source of the information that the machine has been using to generate this, right? Therefore, I think it's, and you find, like we spoke about efficiency gains, this is and can be a massive efficiency gain, yeah, but it doesn't necessarily mean that it opens the door for arbitrage or further gaming. I think it's the opposite even, because in a lot of places you find the efficiency that these things are processing information allows the user to come up with more accurate decisions and more accurate choices. And at the same time, it's objective. Yeah, by definition, the assessment is more objective than just having a human generating the report.
Andreas Hittner, former Vice Governor of the Central Bank of Austria. I have a question to the panel. And we have heard in the morning that actually to build greenfield operations is the most efficient thing nowadays. And my first question is, do you think that AI would, at the end, what has been theoretical mentioned, possible to make up a bank? So is there a more or less automated bank thinkable? And if yes, what are the 2 or 3 main strategies or main issues the incumbents have to concentrate on to be very strong competitors to this possible AI generated bank? Thank you.
Let me maybe give it a start, and then the colleagues can chime in as well. I agree from a technological perspective, right? If I could imagine starting a bank from scratch without legacy issues, then of course, like from a tech perspective, it's simpler, but connected to what I explained earlier, it doesn't give me the domain expertise that I need to be able to run a bank. Yeah, tech, definitely clear, it's easier. Like really being able to understand banking business, understand the banking sector with all the components, right? About regulation, really lending strategies, customer demands, market demands. This is not something that comes automatically. Therefore, it is a topic, and it is a topic also for incumbents to say, do we want to migrate our infrastructure, or do we want to build a shadow infrastructure on the side and basically switch parts of our current infrastructure to something we build greenfield, right? Which can be an efficient approach, but I don't think it's as simple as it might have sounded earlier to say, if I had a choice to build a new bank with a banking incumbent, or just from scratch with a tech firm, it's a difficult question. I think I would be opting for the first scenario to say, I do want to leverage the domain expertise and the legacy understanding that a banking entity has. Also from a data perspective, right? And that's something people tend to forget about. The legacy brings a lot of experience also in terms of data. And if I start something from scratch without experience, without the data legacy, it's going to be a challenge.
Maybe to add to what you have been saying, I mean, first of all, I agree. And if we think of an example of a bank that has just newly been created, very agile, very digital, lacking all that data, and it can go to open source web pages and access all of these available LLMs and fine-tune them and so on, but in the end it is missing the context of the knowledge of the people that are sitting in the bank and that really know how, from a strategic perspective, a certain thing can work. And it can be like coding for a specific product or business segment, or it can be related to credit. But you do need the human critical thinking behind it.
I'll just add to that, like related to that, so because this speaks directly to some of the recent work that some colleagues did at the BIS, there's also the other side of it, right? To consumers, are consumers going to trust AI banks, like fully AI operated banks? And so we found, like we recently, well, not we, because it was colleagues, they recently did a survey in the US, surveying households, and there is an issue of trust in AI applications in the financial sector, where it was very clear that people prefer human augmented sort of services rather than just purely AI-based services. And the distrust was even greater when big techs were providing financial services. So there is that aspect as well.
But you're still using it.
Maybe just one example came to mind, but that's a use case I'm working on with a client currently. So that's for the workout function of a bank. And it's actually a use case I was not thinking of myself, that was brought up by that specific client. And the client said, the people, and therefore the expertise that we had in our workout function during the financial crisis is no longer there. Yeah? And if we now imagine hypothetically we need to go through a downturn or a distressed situation again, all that the current team can do is read up on historical documentation and the historical cases, right? And can investigate what approaches work in what scenario. Because this is where the intelligence and the experience sits. You can use AI there, and that's what we're working on with this client, is to say this knowledge that sits in a lot of pages of paper, basically, in a lot of cupboards, I can prepare in a much more efficient fashion for a less experienced user today. Yeah, I can distill and to some extent reanimate that experience and make it available to a user. So that's a clear efficiency use case, but it also underlines the importance of experience, right? And in this case, AI is being used to bring a long-standing experience to a more junior team.
So maybe our last question, if I look on our
one question. You mentioned several times data. Isn't it a problem for banks that the most valuable data are the payments data? And payments has already more or less been lost for the banks because it's dominated by US big companies. And in the long run, it will be dominated by the data monopolies because they can undercut all the others, because with the payments data we can provide the payment services practically for free. So, and in the end, the only solution to avoid a private monopoly in payments would be a digital central bank currency.
Let me maybe start again. I think it's true, there's a bit of a risk of centralization in that space. But what you do see happening is on topics like transactional analytics, that's a theme where especially the large players are moving and are trying to move rather quickly now. Because there's still on transactional information, there's still a competitive advantage, because a lot of the analytical capabilities you do need to train on observations, right? That you don't get, for example, use PSD2 as an example. You don't get a full history of information. If you want to train analytical models on transactional data, you're still better off at this stage if you have a broad and deep scope of data that you can train your models on, right? So that's not fully answering your payments question, but I think it's understood by the industry to say there are some pockets where big players and the large banks still have a competitive advantage versus fintechs and the startups and so on, right? And from my experience, there's a lot of focus on exactly these topics where they're trying to sort of claim and reclaim their role and their mandate in that space.
And maybe to follow up, I think that apart from payment data, which, as you were alluding to, has been happening for some time, that transition of data going away for some banks, what has also happened is that banks have been adapting to that new reality, and in order to be able to make decisions and readjust their engines, they have been gathering data from new places. And like right now, we can imagine of a credit assessment or a new onboarding client assessment where data is not only coming from fundamental sources, but also from data that's on the internet, behavioral data. So the analysis is much more holistic and data-driven, but not necessarily data that the bank has, data that it's just out there, because everyone is online and companies have websites and they have a digital footprint.
Okay, then I thank you all for your contribution, and I think there are a lot of opportunities. There are some risks, but I have to say I recently heard a presentation on AI used in the US presidential election, and I have to say these are many risks we are talking here about, how AI is used at the moment in the US in this election. This is really something, a big challenge for the society. So I think we as a bank are more used to handle this risk thanks to regulators and risk analysts. And so I don't know, I have to give back to you to end the session or the event. So please, and thank you once again for this presentations on the panel.
This concludes our SUERF-Unicredit Foundation Unicredit Bank Austria event on AI in banking and finance. Thanks a lot to our speakers for making it to Vienna and for sharing your knowledge with us. There was so many super interesting thoughts here today. I think all of us and all those online will take along many good ideas along. Thanks to all of you for your many questions. Also, thank you for your interest online. I don't know how many people we had in the stream. I will learn afterwards. Warm congratulations again to Max and Thibault and to your co-authors for your excellent research work and for the prizes. I understand there is a standing lunch buffet outside. So use this as a follow-up and as an addition to the lectures now. For some networking and some for some informal information. Thank you so much.